Hello, X. Hello, YouTube. Welcome to Max's annual office Christmas party. It's Friday afternoon, after hours, time to get together at a virtual party. You know, we don't really have an office here at my YouTube channel, but you guys are like my office mates. I got Retire on Dividends here, and I have some other influencers. I have some better influencers join me after him, but we're just going to start it off with him. I'm just joking, Rod. Hey, thanks.
Take what you can get, right?
Yeah, exactly.
Yeah.
Exactly. Take what I can get. No, thanks for being here, Rod. I appreciate it. No, we're going to have a good time today. It looks like we have some of the crowd here. It looks like, let's take a look at the market really quick. And also, basically we have this. We have 13 minutes until YieldMax gets here. The lineup today is YieldMax is going to be at 4, and there's no time in between. I mean, we're going to go right till 4:20. Then I'm going to have to get rid of. I don't know who YieldMax is sending. I would assume Mike Coe, but it could be Josh. But then after that, we have Matthew Tuttle. But you'll probably have to go after the YieldMax interview. But anyway, then we have Matthew Tuttle, and then we have from till 4:40, and then we have Matt Holcomb from Rex. Then after that, we have David Nicholas from X Funds. Then after that, we have Howard. Then after that, we have David from Quantify calling in from Costa Rica. Hopefully, if everything goes all right.
Oh, wow. Nice.
I know it. I got in, and there's no. I should have scheduled time between people, but if I would have had to. I mean, I would have had to go for 3 hours. It's going to be hard enough getting me to sit in one place for 2 hours. I mean, I'm kind of a naturally antsy person. Anyway, it's all good. Well, let's say hey to let's see who's here. We have Dan in the house. We have Marcus. Hey, Marcus. Bonds in the house. These are my regulars. You guys are always here for me. I appreciate it. And Dividend Degenerate also can't chat much, but you're here. Okay. All right. 'Tis the season to be jolly. Absolutely. I have a hat. I have a Santa hat also, but I saw it yesterday. Maybe I'll go get it on a break or something. All right. Well, what I wanted to do real quick is just what the heck's going on with the market? Gosh darn it. I was just popping in and looking at the screens really quick.
Yeah, it's been a little mostly red.
Yeah, I mean, well, all the stuff I follow, because I have this feature on my show called the Diversified Divas, because I'm obsessed with these funds, ULTY, KYL blocks, ULTI, for whatever reason. Great. I mean, anyway, and so I follow them on a daily basis. But since the day that they came out, or since the day 2 of them came out, and I follow some other ones, yeah. But I signed into this report, and it just was a blocks was down 6+, and ULTI was down. I mean, both of them were down more than 6. The other ones weren't nothing to brag about either. I'm not trying to pick on those two, but I mean, even the Qs were down 2.1. I took the afternoon off and hung out with Jax for a little while, and I went away from the screens for 2 or 3 hours. I come back, and yeah, this is ugly. I hate to see that. Anyway,
yeah, it was good for my a lot of my covered calls were in the money, so I was kind of happy.
Yeah,
a lot of the red. So
it bailed out some of your in the money shorts. Yeah. I mean, that's the cool thing about covered call trading is it's long and short. It's like an arbitrage. I mean, you're not really like an arbitrage, but you're long and short at the same time. So you always have good news on one of the legs. I mean, it may not be the leg you want or whatever, but even if your call's all the way in the money, your stock leg's doing great. So anyway, yeah, it looks bad, and it looks like Oracle did knock stuff down. So let's look at this. I think I have this working, but I'm not sure.
Oracle and Broadcom too.
I was going to say, I just saw on the Diversified Divas, it showed, I thought I saw the Broadcom was down 11% or something today.
12 now, yeah.
Holy cow. Yeah, this is an older version of the same. Well, my AI had this working for about 5 minutes, but anyway. Oh, well. Yeah, no, that's ugly. That's really ugly. You got questions to ask these Yield Max guys, Rod? Because I don't really.
No, whatever comes up.
Yeah.
We'll just hang out.
Did
ask
you hear
whatever.
that? Did you hear Ambassador Quan Space? I listened to it on my phone. For some reason my computer won't do a Spaces event, so I listened to it on my phone. But anyway, yeah.
I caught like the end. I haven't been able to catch. I know he's been doing a lot this week, but I keep missing him.
Yeah,
catching the ends.
It's all right. Well, let's go look at something else. Let's go look at. Give me just a second.
This is the only office Christmas party I'll go to. I usually bail on my company card.
I was just trying to think of something fun to do. I was going to do something over Thanksgiving. Just because I liked your deal, but your deal was right. A couple of weeks before Thanksgiving, I was thinking of doing something like this around Thanksgiving. But anyway, I finally decided, what the heck, I'll just give it a try right around Christmas office party season, which is this weekend and next weekend. I've been to some good office parties. Just a good excuse to drink a lot and that kind of stuff. But anyway, back in the day.
I got an hour commute, so I can't even do that really.
Oh, yeah. No, I know it.
So yeah, let's talk about this. I always see this on your videos. So you add, is this like the ETF versus the underlying in all cases?
Yeah, that's all it is. The blue line is the ETF, the red line is the underlying. So over here, that SPY-T was down 1.01, SPY was down 1.10. But yeah, so you can just see the ones that were getting crushed. Of course, it's ULTI and blocks. And they don't really have underlines. It's not really fair to compare them to the Qs, but that's the closest we have, I compare all those. But anyway, but of course, on a big up day, these things are crushing it on the upside. But this is just a real quick way for me to get a glance and see what's happening with the market. We have, YQQQ and Salty are the only things that are up, of course. And then what's this? Riser, that's an interest rate hedge. And, but yeah.
Now I like this. ULTI doesn't have protective puts. I haven't looked at it yet.
Yeah, well, they have a put. Well, they do. Sometimes they do have protective puts. They absolutely do. Sometimes they run a collar, but no, their latest build though has not had a collar on it. But a few weeks ago when the market was dropping, they had a double leg of puts, which just like ULTY does, it absolutely limit the loss at a certain place. But no, but not right now, or not last time I checked anyway.
Yeah. Okay.
Not last time I checked.
That's a big hit.
Already got our first super chat from Oracle Fast Money Trader. Thank you, Mr. Oracle. He was on here the other day.
Being kind as always.
Yeah, I got you. I know it. I'm just making sure I'm catching.
He might take that super chat back now if he sees me.
Yeah. Well, he came in here the other day and we had a great conversation and he gave me a super chat, and we're on the same page about a bunch of stuff. But anyway, but yeah, all right. Oh man, Oracle, you can't talk like that. Come on, buddy. That's not appropriate. That's not appropriate. Dan will take care of it. Dan will take care of it. All right. So let's look at this. So then after that, I go over here to the yield max, and this is the same thing. This is just yield max against there. So what you can see here is, unfortunately, ULTY doesn't really have an underline, but it definitely was down more than the Q. So it's something to be concerned about. But look at this, Fibby right here was down more than Facebook, 1.9 to 1.4.
That's for today.
That's a one-day basis.
Yeah.
So then you can look over here and see Infly was up more than their parent. That happens very rarely, but occasionally it does. And you can see right here, JPMO you can just visually see who's catching a lot of upside versus the parent, or who's outperforming on the downside. Yeah. So that's one of my That's one of my main ones. But my one I've really been happy about is this one right here, where I can actually look at the individual positions of all of ULTI. It looks like Mike Coe's in the waiting room. But I really like this technology, but I'll show it to you guys later. We got Mike Coe here, and it is 2:56. All right. If anyone has questions in the chat, put it in the chat, and maybe Mike will see it and answer it. All right. Mayor's here. I appreciate that. Ambassador Kwan's here. Okay, everyone's here. We got the A team here. I'm going to go add Mike Coe to the stage. Hello, Mike. Can you hear us?
I hear you. Do you hear me?
I hear you just fine.
All
Can
right.
you hear?
Hey,
Can
Mike.
you hear?
Santa hat, Mike.
No, I like the hat. That's good.
Yeah. You a Giants fan?
I'm not. Well, I mean, which Giants are those? I'm trying to see what I'm looking at. Is that the
The bad ones. The ones that can't get a win if they, if they paid for it. But
yeah. So just so you're aware, I was mostly raised in New England. So
you're
Connecticut, right? I think I've heard you say Connecticut, or
so I did live in Connecticut when I was very young. I lived in New Hampshire. I went to high school in Rhode Island, and I went to college outside of Boston. My brother lives in Connecticut now, although he lives in the part of Connecticut where probably there's a decent percentage of the people that live in that area that are fans of New York sports teams, because he's in a small town called Darien, Connecticut, which is in Fairfield County. It's sort of a bedroom community of New York City.
sure. I bet that's beautiful up there. I've never been, but I've heard that Connecticut's gorgeous.
Yeah, I mean it's a nice state there, all along the Sound there, or a lot of it is. The part of Connecticut that I lived in when I was a kid was actually a suburb of Hartford, so it was not a suburb of New York. We lived in a town called Simsbury when I was a little kid, but I don't really remember that. I mostly remember New Hampshire, Rhode Island, and Massachusetts.
I like you told a story the other day of being in college, I guess at Boston, and going in with some of your pledge brothers on some options. We did the same thing. We did the same thing in my fraternity in Oklahoma, and I was the guy with the account. I was the same story. I really what was the stock? What stock were you buying options on? Do you remember?
Yeah, it was an insurance company, and I should remember what the company was. It was some insurance. My roommate's stepfather was in the insurance business, and they lived, I think, near Pittsburgh. And it was some obscure insurance company that he thought was not his own. Yeah. That he said we should buy puts on. And like I said, of course, there's many years hence, but at the time I was just like, oh, he has insights. Now, with the benefit of hindsight, and I think I mentioned this when I was on before, why would somebody call their stepson to execute an options trade? I mean, it can't be a good reason, right? They would presumably do that themselves. So, as I look back on it, I'm like, boy, that's probably pretty shady, whatever it was that he was, the insights that he was giving us. And then, of course, as I pointed out to you, and I guess you did the same thing, once other people inside of our fraternity heard about it and they didn't have an account, they're like, hey, I'll give you $500. Can you go buy me some? And then, of course, at the end of the year, recognizing that, because it's not like I normally had to pay taxes. I mean, I was just a college student, didn't have any money coming in. And then all of a sudden I was like, oh, there's a tax liability. You probably need to go back to everybody. And they'd, of course, long since spent the money. So my first big trade like that was in, I think, United Airlines. And it was because it was being rumored to be taken over. They were talking about it on CNBC for months. But anyway, and I bought a call and got lucky because more takeover talk happened afterwards and thought it was the greatest thing ever. But yeah, it is interesting. So I was speaking at an event last week, on Monday of last week, in Sarasota, and I was asking the people in the audience, just by show of hands, what their method for stock picking was. So how many people use technical analysis? How many people use fundamental analysis? And if they don't use one of those two, what do they use? And because I would say about a third held their hand up on the fundamental side and about a third held their hand up on the technical side, which meant that there was a third that hadn't held their hand up on any. And a woman in the front said, well, it might not be such a great idea, but I actually just use the news. So, whatever's in the news that day, I kind of trade off of that. And she said, it's probably a bad idea. And I said, it's interesting that you should mention this, because if you do comprehensive factor analysis, or you have tools available to you that will help you do that, one of the things you will see is that actually story count is actually pretty predictive of a stock's behavior over the ensuing 30 days. So if you took a look, for example, over the course of the last year, if you took 1,000 stocks and you evaluated them every day, and every day you counted how many stories have been written about this company within the last 7 days, what you would find is that those that had the highest story count outperformed those with the lowest story count quite considerably. In fact, I can actually tell you by how much. This is going to be updated as of today, but I can do it over any period of time. But it's a surprisingly Josh, how are you? So in terms of stories, the top quintile outperformed the bottom quintile 92% of the time. And the outperformance over the course of the last year. So if you had simply bought the top quintile and shorted the bottom quintile, you'd be up 19.5%. And that has a Sharpe ratio of 3.76%. So you would, it has an average monthly return to be long the top, short the bottom of 1.5% per month. And probably a lot of people would not have thought of that, or there were probably people in that room that were snickering about it and thinking, oh, you just listen to what they're saying on CNBC? Well, turns out that as a stock picking approach, as a technique, it's not as inane as it might first appear.
I just got lucky. I think my dad had to buy it for me actually the first time, and he just let me do it to show me it was a sucker move, and we just got lucky. But then we bought some more options after that and lost it anyway. So yeah. Lesson learned. But no, it was fun though to have the first one be one that actually something happened. I think somebody else put in a bid and the stock went up overnight. Anyway, hey Josh, how you doing, bud? Thanks for being here.
Doing well, of course. Yeah, thanks for having us. Really appreciate it.
Yeah, no, this is fun. I'm going to get Mike for a full hour, and we can ask him a lot of questions. But I saw a question in the chat. I
want to ask Mike real quick how he's able to join right before the closing bell, right? I assume all the trades were done, right? No chaos. But
the good news is we have 40 traders over here.
Yeah.
And my role is more on the investment committee side. So there's on the Ulti investment committee now, there's about 7 people. I'm one of those 7, but there's a lot of traders who are executing these trades, and there's a lot to be done. Today I'm looking at the blotter. Wow. There's a lot to be done.
You can see them make the trades live, I assume, right? Probably from your terminal.
Yeah, I'm actually on the same system. So I can see every trade. I can see them when they're entered. I can see where they're going. We have 1,448 individual parent level orders today. 1,448 trades. So
that download is growing each day.
It's this will keep you busy. This will keep you busy for sure. In fact, actually, let's see I wonder how many different symbols we've got here. It's a lot. I can see, like I said, I can see every trade. I can see every child order as the orders go in. And then in many cases, I'm part of the chat where when trades are being discussed before they're even entered, some of that is, sort of debated inside of the IC chat, the investment committee chat. That's usually just sort of high level conversations. One of them, which I noted over the last couple of days, we had Robinhood in Alti, and Mike Venuto had some good insight following eToro's KPIs on Monday. So eToro came out after the close on Monday, and their KPIs were not that well received, but it didn't really impact Hood that much. And so on Tuesday, he instructed the trading team to buy puts on Hood because they were going to be releasing their KPIs on Wednesday after the close at 4:05.
Wow.
So they bought the 130s. And, then we watched those results came out. Stock traded nominally lower, like 250 basis points or so after hours. It was a little lower on Thursday morning. And the decision at that point was made like, oh, I guess we thought this might hurt the stock a little bit more, but I guess not. So those puts were then rolled to the, further out to the 120s. And then the stock rolled over, of course. So, so sometimes it was, and actually I asked Mike Venuto, I said, who were you talking to that sort of got you clued into this? And because it was good insight. It was a good insight that we got from them, and Mike Venuto's instincts were correct. But just unfortunately for us, the timing was not great. It actually dipped below 120 today. I don't know where that closed.
I think it closed around 119. Last I looked at it.
So that was a little frustrating. Yeah, that was a little bit frustrating that they had it on so perfectly, and then that will happen. Look, it was good. The 120 still paid, right? They still appreciated in value, of course, but the 130s were it was perfect what they had on. And then I think honestly, if there had just been a delay in the chat, it's like sometimes it's better to be lucky than good. I wish we'd been a little bit lucky, and the way we would have been lucky on Thursday morning would have been if somebody didn't look at the screen right when they were supposed to, just gotten distracted, gotten a phone call, just something that could have held them up for 30 minutes. And then they'd look over and the thing would have been trading 127, and they'd be like, hey, this is working. Let's just see what happens.
What I think is interesting is that the market didn't react more to eToro's numbers in Hood's stock price, before that. That seems like almost like a no-brainer, right? That they would be in line with one another. I'm sure they have a similar clientele. So I think that was really.
They do. This is the kind of thing that there is some informational asymmetry, not as much as there once was, but there is still significant information asymmetry. And I think the reason that this didn't have the same kind of read through that you sometimes get is because KPIs aren't necessarily as broadly observed as earnings are, right? So I think it would be safe to say that when the self-directed brokerage platforms are reporting their quarterly earnings, that everybody who's invested in any one of them is watching the first to report what's going on. Something like KPIs, it's not as widely followed or observed. But we're looking at our new account ads, and they just reported earnings maybe a month earlier. They're not going to be reporting for another 2 months. So people aren't really keeping as close an eye on it. And sometimes you can really, to your point, Josh, if you're on top of that kind of thing, you can actually stay ahead. And we were ahead. That's the part that just kills me. Yeah. We were actually too far ahead.
I got a question for Josh or it's for either of you guys from the chat, but this is from Mayor, and he said, your inverse funds are on fire, and I have all of them, and I do myself. I have 2 of them. Anyway, Winter is his top performer. How about some more of these? Are you guys going to put out any more inverses?
I haven't heard any rumblings of that yet, but I could definitely see that being in the cards for 2026. We have a lot of focus on the Target 25s recently, as well as some other portfolio products that are going to be launching hopefully at the end of Q1. Haven't heard much of a conversation about offering new inverse products, but I guess my question to you would be, if we were going to do that, what do you think would be the most interesting tickers to have inverses on that we don't already?
Yeah, good
I'd say
question.
Palantir. I think that's your next biggest
Palantir,
one.
I think would be, yeah, Planty and Hui, I think could be top candidates for that. Definitely is an interesting question and a conversation that I'd like to open up with the team more, because giving investors, the ability to gain income on both sides of the trade, I think is a wonderful thing to do. And proof of concept has, really, shown itself in winter, so like, definitely we'd like to have more of those products available to investors. And I'm sure that's something that will be a topic of conversation going into January with the product development team.
Hey, let me ask you a question, Mike Coe, really quick. And we don't have to get too in depth in this. I think I heard you comment on this same thing on other shows. But what's the deal with the 3-leg option callers, selling the call and selling the put and then buying? I like it, but I'm saying, what's the deal? What's that trade even called? Is that a covered strangle with a collarized covered strangle, or what are you guys doing there?
You basically have a short put spread, and is one way to think about it. You have a short put spread, and however you want to phrase it. A short put spread combined with a covered call or a collared stock position, because basically in those situations, the one that I keep talking about was the first one that we did, which was NVIDIA, which we don't hold in Ulti anymore. But at the time we had 400,000 shares of it. We were short 4,000 calls, short 4,000 out of the money puts, and then long 8,000 further out of the money puts. So however you prefer to think of it is probably a fine way to think about it. But you could say, okay, well, they were short 4,000 put spreads, and they were long 400,000 collared shares.
Sure.
That's one way to think about it. As you think about how something like that pays and why it would make sense in a stock like that relative to some of the constituent types that Ulti traditionally would hold, a stock like Palantir, high vol, high options premium, hims and hers, similar situation. Compare that instead to something like NVIDIA, which is not low vol, but it's certainly lower. Now, in a situation like that, if the stock just stays still, or even if it dips a bit or rallies a bit, essentially you're going to get paid on both the short call and short put. You're still fully hedged because you have puts against both the short puts and the long stock. And actually, not to make things even more complicated, but another way to think about it would actually be 2 laddered short put spreads. Why do I say that? Because what is long stock and a short call but a synthetic put, right?
Yeah.
So therefore, if I have a $100 stock and I'm short the 105 calls against that stock that I'm long, and I'm short the 95 calls and I'm long the 90s, synthetically, I'm short the 90, the 105 90 put spread, and I'm short the 95 90 put spread. So, it's however you want to, whatever makes people comfortable when they're thinking about it in their own minds. Vol traders like me, we have a tendency to think about all upside strikes, because we typically trade neutral, as calls, and all downside strikes as puts, regardless of whether they're calls or puts.
No, I know what you mean.
Yeah. So whatever makes people, I think sometimes conceptually it's good to try to build these trades a couple different ways in your mind. They all have the same payoff effectively.
Yeah.
But, getting really comfortable with synthetics just means that when you look at a whole bunch of options positions, it just makes intuitive sense. Like the payoff picture just shows up in your mind if you look at it enough, and you just convert those. So when you're converting stocks, long stock, long put, that's a synthetic call. So immediately you could also say that synthetic short put spread is also synthetically and in the money long call spread, because a short put spread and a long call spread of the same strikes and expiration are synthetic equivalents of one another. Again, I'm not trying to confuse anybody. It's not that hard. If you just work through it a little bit on your own, you'll find yourself getting really comfortable with these concepts. And then every single time you look at a board of options positions, it'll just sort of make intuitive sense.
Yeah, we talk about it all the time on my channel. That's what I figured. I figured you were either trying to lessen the put drag, or maybe trying to boost the yield a little bit by getting stored.
Well, it's definitely the latter, right?
Okay,
So the whole exercise here is how do we basically fulfill the promise, Ulti's promise, which is, high yield, right? That's the objective.
Yeah.
And there are different ways one could accomplish that.
Yeah.
I've heard Josh mention, leverage. It's not leverage in the traditional sense that some other competitors to YieldMax employ it, which is to actually have more net long at spot, which you could do either by margining stock or with levered total return swaps. There's a couple different things people could do. Another way I like to think about it is that if I own stock, and this is, by the way, there's a lot of big asset managers who have employed a strategy like this, usually further out in time than these, because these are short dated options. But, whether you're looking at folks like Leon Cooperman at Omega, the former head of Goldman Sachs Asset Management, Pete Koppel over at Glenview, people like this, these are folks that typically have very long-term views, have valuations that they assign to the securities that they hold, and say to themselves, look, I have a position in the stock. I like it. I would buy more at a discount, and I'd be willing to let some go if it trades up.
Yeah.
So what do? They buy stock and they sell strangles around it.
Yeah.
If it goes down to the put strike, they'll acquire more stock at a lower stock price. If it goes up, they'll end up selling it at a higher price. And in either case, they're going to get paid the extrinsic premium on both the upside and the downside. And if it just stays put, they're getting pushed from both sides.
No, absolutely. Absolutely. Well, I was glad to see it. You guys have innovated with Alti. And Josh, what kind of stuff can we look for in the new year from YieldMax? Could you give us any hints? I'm for more lightning spread type stuff, but can you tell us about any new things that you have coming out that you're happy about besides the 25 target?
Yeah, of course. I mean, so you can see from our filings that we have a lot of things in the pipeline. We don't have any slated launches at the moment, but I think that's just a product of it being the holiday season and the team still kind of organizing what products we think we should release first. One thing that I'm really excited for is the Hundi ETF. I'm sure you guys have heard about that idea, fund of fund, where we prioritize basically investing into the YieldMax funds that consistently pay over 100% annualized yields. I think that's going to be a hit, especially, for Ulti already has been such a big hit. I just could see that being, something that investors are very excited about, as it, will be a diversified way to basically invest into all release for really excited about the Quad D ETF, which is going to be the double SCHD dividend ETF. So basically, everything that SCHD pays on a quarterly basis, we're going to double that. And I'm not sure how much I'm allowed to go into.
Are you going to?
It actually is. I mean, from what I understand, we haven't released a prospectus on it yet, so I really don't want to go into too much detail, but it is going to follow,
so it'll mimic it that way too. Wow.
Yeah, SCHD distributes quarterly, so it would make sense that we do that as well. So that will be a completely different distribution schedule from what we're already following, of course. So I'm really excited for those two products. And then, we just the other day filed for some new portfolio products as well. One of those that I'm really, really bullish on and excited about is it's going to be called ROBY, our robotics portfolio. I mean, just looking at the success of the portfolios we already have, like GPTY and CHPY, as well as LFGY, I just think that that's going to go hand in hand with those products and be a great success. Robotics is a space that I'm, pretty bullish on in general, and I know a lot of investors are as well. Think that product will be a smash hit, and as long as that market continues to go up, should be a great income producer. I mean, there's a lot of volatility in that space, of course. So Yeah, those are just a few of the things that we're interested in launching. I know you mentioned the lightning spread idea. That's something that's certainly on the whiteboard. I've talked to Venuto about that a bunch of times. We haven't filed for anything yet that is going to be like a lightning spread fund, of course. But I could definitely see us doing something like that in 2026 at some point. Certainly going to prioritize those other products that we've already filed for first. But I think that the lightning spread idea is really cool and a great idea. And, if there's investor demand for it, we want to offer that as an investment solution to our community. So yeah, definitely something we'll be talking about more in our weekly spaces, as well as a team with the product development side of things. So yeah, a few things that are coming right now.
Hey, well, thank you. Well, I appreciate both of you guys being here. Sorry this was quick, but I have another guest in the waiting room.
Sure.
But I appreciate you guys being here. But let's get together after the new year. Once you can talk about some of these new products, I would love to hear more about all of the stuff we were talking about here. So I'll set up something in January.
I'm going to say one thing before we go. I just had one of the traders ping me.
Okay.
Gave me the weekly total returns for Ulti, Salty, and the Trip Qs. Salty was up 30 bips. Ulti lost 80 basis points, and the Qs were down 190 basis points week over week. So this is the best outperformance that Ulti has seen since early October. So hopefully some of these changes are taking effect. But I really appreciate your time, and I love the hat. I got to get one of those. Mine's probably not going to say Giants on it, though.
Yeah.
Mine will. Mine will say Giants on it. I was going to say, that's awesome. So I'm with you
Wear
there.
it proud.
Yeah. Even in dark times.
Thank you, guys.
Thanks
You
a
guys
lot.
have a great day. Thanks again for being here. I appreciate
you
you guys taking the time to be here.
You too. Happy
thank you
holidays,
very much.
everyone. Really appreciate
Y'all have
it.
a great weekend. Cheers.
Take care.
All right, we have Matthew Tuttle right here. And hey, Health and Wealth, how are you doing? What happened to Amy? Is Amy all right?
She went to get a drink, but she had to go to the farm next door, I think.
Okay, as long as she's all right, she can be back. It's come and go type thing. All right, here we go. We have Mr. Tuttle. Now, those last guys were telling us, Matthew, that they don't have a lightning spread product coming out. Come on, that's BS. You have a lightning spread product coming out, or lots of them, don't you?
Yeah, we're big believers that most of the time writing calls on stuff is kind of stupid.
Yeah.
But put spreads or writing puts or writing put spreads, that's the way to go if you want to generate income. So yeah, we've got 2 products we are trying like heck to get out this year, and then we got a bunch coming out next year.
Now that's awesome. I'm super excited. With some guys in my Discord were joking that we need Ono to be out now. I mean,
I am dying for Ono. I just hit up Goldman Sachs on it today to push them. I talked to a financial advisor who manages like 600 million. He's salivating.
Why don't you
I cannot wait.
Why don't you give about a 1-minute explanation of what Ono is for the people that aren't in on this? It's a new ETF you have coming out, but tell kind of what it's going to do. It's kind of complicated.
Yeah, more than kind of. I mean, so, you guys know options are cool, and options allow you to do a lot of really neat stuff. And unfortunately, what you see typically in ETF world is just basic stupid stuff. So what Ono is it's called a no bleed tail risk ETF. The idea is the 99% of the time the market's up, we want to be flat to down a little. Then that one year out of 5, or that 1 year out of, whatever it is where the market just blows up, we want to blow up to the upside. So that's the idea. So we want to be like, down 1, down 2, up 1, flat, up 50. So the thinking there is you can keep it in your portfolio. Versus like, the financial advisor I was talking about is like, I'm going to buy puts. Like, dude, the problem is if you buy puts and you're wrong, you lose all that money and your clients get pissed. And, the problem with traditional tail risk is you just sit there and you bleed profusely until you finally decide, I've had enough. The market's never going to go down. And that's the moment the market goes down.
Yeah. No, absolutely. I'm excited about that too. I'm excited to see what mechanism you're going to use to offset the bleed. And you have like 5 parts in the prospectus. I haven't even done a review on it, but no, it looks really interesting.
Yeah, it's going to be complicated. Lots of ratio spreads and, all sorts of more complicated option strategies. The flip side is if, a day like today, Ono wouldn't have done much for you because, the market was only down 1%. It's designed for, COVID, 2008, those things.
It may have helped in April or something.
It may have helped a little bit, but it wouldn't be great. I've got ratio spreads on Qs in my portfolio. I think they were flat today, unfortunately.
Oh, yeah. And if you don't want the market to go down, those will just land in the valley of death unless the market really goes down. What I liked about your prospectus, now that I'm thinking about it, you mentioned in there you're going to use something aren't you going to like own a straddle or something? So you get like, what did you call it? Like you get volatility that's close to the money, at the money type volatility on a daily basis. But then I guess you're going to use that to kind of offset the valley of death or.
Yeah. We're going to have exposure to so much stuff. You want exposure to volatility. The great thing about volatility in a market panic is it goes parabolic to the upside. So you want to have exposure to vol. And then we're going to also have, some traditional kind of spread things for when the market goes down a little bit. It's going to be a lot of fun.
Yeah, I know. I can't wait to see it. Well, Amy, Miss Roundhill, do you have a question for Matthew, or what about you, Health and Wealth? Any of you other guys have questions?
Yeah, well, this is the first time I'm hearing about it, so I'm going to ask Max if he could send me the prospectus so I can look at it later. But my first reaction was like, could we also have an Uno? Oh, no.
Yeah.
Well, no, what we're going to have with Ono is we're going to have Hell Yes. So what Hell Yes is going to be is 100% S&P and 100% Ono. And it's an index. We made it into an index and we back tested it back to 2008. So Ono, if you just own that from 2008 until, I don't know, like a couple months ago, you would have doubled your money. Past performance doesn't predict future results, all that fun stuff. If you had Hell Yes, you'd have beaten the S&P by like 6% a year on average with the same volatility, and you would have been up in 2008.
No,
So
that's
I'm almost looking forward to Hell Yes more than I'm looking forward to Oh No.
There's another company came out with a long short fund, and they're also selling some premium, and it'll probably be a nice fund. But I think a lot
nobody on the ETF side has been able to make long short work. The only guys that make long short work are like the really, really, really smart hedge funds. And to me, if I can get 2 and 20, why am I going to do long short in an ETF? I'm not.
Yeah. Well, what I was going to say is, what I was trying to think. Well, I forgot what I was going to say, but I know what I was going to say. But a lot of people in my Discord and stuff were hoping that the long short fund would kind of be like more like a hedge. It'd be different than what it is. This is just a long short fund. Nothing wrong with that. It is what it is. But they were hoping it would be more like a fund that maybe sold that did bullish trades on bullish stocks and bearish trades on bearish stocks, and an income fund that was fully hedged. Yours, it might be that fund that the people were hoping for. I'm saying, yes, the long short fund is nothing like that. It's just a fund that's long and short.
Yeah. I'm dubious that we will see a good long short fund in an ETF.
Yeah. But your is that not going to be a long short fund? You're 100% long, and then you're going to do it.
But it's not like when I think of long short, I think of a portfolio manager that says we're long the stocks we like and we're short the stocks we don't.
Yeah.
What I'm saying is I'm going to be long the market and I'm going to be long tail risk
at the same time.
Exactly. So to me, totally different. My kid works at one of the best long short hedge funds in the world. Yeah. What they do, totally different than what I'm talking about.
Yeah. And I know what you're saying. I was just confusing being long short with being hedged. Yours is going to be, it's going to have a hedge component on it. But yeah, long short's a totally different discipline. Like you say,
Right. Yeah, to me, I mean, if you're playing around in the option income space,
yeah,
you don't want something trying to wear too many hats. If I'm trying to generate income on an ETF, I don't want that ETF also trying to go short and this and that, so which is why we're coming out with put spread ETFs. You could argue, well, hey, Matt, your put spread ETFs are going to have more downside than a covered call ETF. And, it lower downside, we actually don't. Lower downside put spreads are better. But big downside, yeah, we're going to have a little more downside than a covered call ETF. But to me, buy a covered call ETF, you want income, you want capital appreciation, and then take care of your downside somewhere else.
I'm with you.
That's like, in the olden days, they used to have the balanced funds. And only idiots bought that because it's like, dude, I'm just going to buy a good stock fund and a good bond fund.
Yeah.
You're not going to be able to do that in one package for me.
No, I know what you mean. I hear what you're saying. So talk a little bit about BITK and MSTK. How are those going? And are you coming out with the TSLTK or something? Or
yeah, so we'll see. So, and again, I'm different than the guys you're probably talking to from the standpoint of, I'm a trader who happens to run an ETF shop. So I look at everything from the standpoint of, would I do that myself? And if I wouldn't do that myself, I'm not going to ask you to do it. And so I'm not a big fan of traditional covered calls, so like take a stock like MicroStrategy, which I like down here. I've liked it down here for a couple of weeks. I've been wrong. I still like it down here. But would I buy 100 shares of MicroStrategy and write a weekly, monthly, or quarterly call? No, because if I'm buying it, I think it's going to go up 50%.
Sure.
So what we do on BITK and MSTK is we've got exposure in BITK to IBIT. We've got exposure on MSTK to MicroStrategy. We're writing calls at some point intraday and covering at some point intraday. And to me, that gives us a bunch of advantages. Number one, I can decide when to write a call. So on MicroStrategy today, I wrote a call at like 10. I covered it at like 11. And then I wrote another call at like 2. And I covered it at like 2:15.
yeah,
So yeah, I got 2 bites of the apple. I made money on both trades. And, now hopefully Bitcoin will be up over the weekend and we don't have to worry about being encumbered overnight and over the weekend. So, that's what those strategies are about, is we're going to write options during the day and we're going to be fully exposed for overnight and over weekend gains. My timing has been horrific. We launch these and Bitcoin goes down, 30 points.
yeah.
But at some point, we're going to have overnight gains in Bitcoin and MicroStrategy. And that's when these things are going to shine.
Absolutely.
I have to hop off real quick. Sorry. Sorry I didn't get to talk much to you, Matthew, but I'm sure we'll talk soon. Thanks for having me.
I'm sure we will without the Giants hat, though.
Hey, you can't hate on them.
Patriots fan.
They can't win anyway. So
Yeah, but they can beat us twice in the Super Bowl.
Thanks for being here, Rod. I appreciate you.
Ruin your undefeated season.
I know.
All right, I'm out of here, guys. Take care. We'll talk soon.
All right, sounds good.
I got
Yeah, no,
something to
Matthew,
jump
I was
in here.
just wondering about, I pulled it today, and actually BITK was down like 19%, but IBIT, which is the asset it tracks, was down 19.4 or something. They were down right the same. But yeah. Just I mean, but actually then I looked at the chart, and if you look at the first 2 weeks, it was actually up.
Well,
Because
the first two, so
Yeah.
my timing I thought was perfect. So
Yeah, I
we
know.
launched and then Bitcoin ramped.
Yeah.
And that's, we paid out a 300% dividend, which
Yeah.
looking back, all right, that was probably a mistake, but I was from a marketing standpoint.
I know.
From a tactical standpoint, I'm looking at it. So I've got a saying that I probably didn't make up, but I can't remember where I heard it. So let's assume I did. It's when you're ready to start patting yourself on the back, take profits.
Yeah.
So we launched this thing, Bitcoin ramped, and it was perfect because we're getting all the overnight gains. It's great. And I'm sitting there and it's time to distribute my first dividend. And I'm like, man, Bitcoin's gone up a lot.
Yeah.
I'm going to distribute a ton of money because I just can't. Yeah, I'm worried from here, and so that's what we did.
Your NAV was up 4%. I looked at all the numbers today.
I mean the first week or so. The first week or so was crazy, and then I'm getting excited, and then again I'm thinking my favorite saying. I'm like, oh crap, this is not going to end well.
Oh well. Well, I want to get you back on in January or whenever. I want to get you when your Income Blast product comes out.
Yeah, again, we're going to probably Mimi, MEMY, and MAGW. I think are going to get out within the next couple of weeks.
Okay.
And then I'm really excited for the thematic ones next year.
Perfect. Yeah. Well, definitely. I'd like to get you on for an hour. Maybe when the thematic ones come out next year. I think that'd be a good time. Matthew, I appreciate you being here. Sorry we just have 20 minutes, but I think this was fun. Like I say, we'll talk more later next year.
All right. Sounds good. Let me know.
All right. Thank you. And have a good day.
Bye.
Hey, me, I got you back on stage. Okay, I have Matthew Holcomb, and we're actually 3 minutes early, but he was already there. So,
oh yeah. By the way, there was someone that commented that Matt has a newsletter. The heat
yes, I put it up. Yeah. Well, there it is. It's in the comments.
Yes, I saw it flashing across the screen. I just wanted to shout that out.
Yeah, absolutely. But I'm going to take it. But anyway, and I'll put it in Discord River. But I'm going to take it down now that we have our new guest on. He may have something that we want to promote, or I like to put pertinent questions that come up. So if you guys have a question for Matthew, now Matthew Holcomb, we'll just put him on and let him talk. But he's from Rex.
Hi everybody.
Hey, how are you doing, sir? Well, I'm doing good. I'm glad to have you on. Tell us a little bit. Your name's Matthew Holcomb, but tell us about your company and what about the fund you manage. Give us about a 1-minute bio.
Okay. I am a portfolio manager at Rex Shares. The portfolios that I manage are some of our growth and income products, which are single stock, where we sell a slightly out of the money call each week. And our newest product is ULTI, which is a basket of 20 stocks, some of the highest volatility stocks. We're trying to generate maximum income on those in this portfolio. We reboot the portfolio every Friday. So I must be a little crazy to agree to do this after the Friday afternoon chaos and the way the market was today made it a little bit tougher. So we reboot the portfolio, kicking out some stocks, putting in some new ones, and resetting our options each week.
Can you tell us what you kicked out today? Or, you just got done doing that, right?
Yeah. Off the top of my head, it's kind of a blur right now.
I got you.
I would say to people, go to our website over the weekend. You will be able to see those changes. We post absolutely everything out there. So you can see that.
We look at it on a daily basis. We even notice when you're hedged, there's oftentimes you'll have a double portion of puts, out of the money puts.
Yes.
To colorize your trade. And then there's sometimes when you'll just have a single portion of out of the money puts, which still serves a purpose, but it's a different purpose.
Yes. And although we sell we sell at the money straddles, if the stock rallies, we try to buy in those short puts when the market gives us an opportunity. And fortunately, this week, although today wasn't a good day for ULTI, I don't think it was a good day for too many things. It wasn't as bad as it could have been because earlier in the week we bought in a lot of those short puts. So some of the downside damage was limited.
Yeah. Well, what's your AUM right now? Last time I checked, it was 11 or something.
I think we're around 9.5 right now.
Okay. All right.
Yeah, and that was after today's sell-off.
Well, yeah, you're right. And I checked it yesterday. I've probably checked it a few days ago. So the single stock ones you manage, those have been very well received amongst the people I talk to. And my theory and what I tell people is, and you guys probably don't like this idea, but what I say is you took two successful strategies and kind of melded them together. there are some companies that do covered call spreads, and that works out in some good situations. And you did that, but at the same time, you're also melding another idea, another income idea, in doing it in kind of halves. And it seems to be like you may have like the best of both worlds scenario. Is that anywhere close?
Yeah, we think so, because we thought one of the flaws with the covered call products is, let's say you're selling a call that's 2% out of the money each week. Well, if the stock goes up 10%, you're missing 8% of those gains.
Sure.
And we didn't want people to miss those gains, and that's why we only sell half of our length in the weekly calls.
So, but then you use a little bit of leverage too, right?
And yes, also, and we use leverage. So our prospectus says we can be between 1.05 and 1.5 long. So we maintain that range. It's usually at 1.25. Unless we have a strong market view, or if there's a lot of momentum going on in the stock, sometimes we'll let that run. But generally, it's 1.25. So we'll sell 0.625 of the call, so that if you get a big move, you're still 0.625 long.
Yeah, no, that seems to be a best of both worlds strategy, and that's what I'm waiting for in that one is a fund of funds. I don't like the single stocks; they're too volatile for me. But I would do that in a fund of funds situation.
Well, I'm not allowed to speak too much about that, but for compliance reasons. But I can tell you that we have filed for that.
All right, that's fine. I think maybe I've seen that filing before. Okay. No, that's great. All right. Well, what about? So yeah, you probably can't talk too much about stuff that's coming out, but. What do you think about the idea of? Well, I'm interested. So, how does the back testing process go? How the heck did you come up with that 4-leg, option overlay strategy? Is that something that institutions do all the time, and it's no big deal, or is that before I joined Rex, I was at a hedge fund for the last 20 years, and we traded every kind of option strategy that you can think of, and so coming in and trying to create a product for Rex, people want income. So the maximum way the way I think of income is to try to generate as much time value as possible. So the way that you do that is to sell an at the money straddle. And at the money straddle is all time value. Of course, that's a very risky strategy, right? So, sure. So that's why we add a low delta call that we buy and a low delta put. So, some people think of it as the straddle versus the strangle. I think the easier way for investors to think about it is we sell a call spread and we sell a put spread each week. So you're gonna lose on one, you're gonna make on one. If the stock sits right at the strike price, then you're gaining on both sides. And we're also long the individual equities on all those to try to generate some growth and to try to eliminate NAV erosion in these income funds, which is a legitimate complaint that some people have with the NAV erosion over time. No, absolutely, absolutely it is, and that's what I'm saying. This kind of half and half strategy seems to be seems to be a good compromise. It seems to be working very well on those. How many of those funds do you have out? Do you manage all the single stock ones?
I manage 5 of them. We have 9 total.
All right. Amy, do you have any questions for Matthew? If any of you other guys have questions, be sure to. I'm not trying to monopolize them. I could ask them about options all day long. Yeah,
it's nice to meet you. And of course, my dog has something to say too. I was trying to get him to come. Anyways, I just want to say I'm looking forward to the funds that you're coming out with. Are you looking at this year or early next year?
We're hoping early next year.
Okay.
Nice.
Thank you, Amy. Health and Wealth, do you have something?
Nice to meet you, for sure.
Nice to meet you.
Yeah, I'm taking a look at your website. I've been a FEPI follower since its beginning, 2 years ago, 2 years and 2 months ago, basically. So it's been around for quite a while, down just 10% in share price in that 2 years, but paying out a pretty consistent distribution every month. Yes. So That seems to be probably your most consistent fund. Am I right about that or wrong?
Yeah, I would say that's right, and I would say that's it's probably going to be the least volatile of our income products. We kind of look at it in tiers. We have the EPI suite, and then we have the single stocks, and then ULTY is going to be more volatile, than all of those.
Yeah, nice. That's great. Your website's super simple to look at. I'm cruising around on it right now, and so that's always good for the retail people like myself out there that just want easy information, right? So that's great.
Yeah, we try to update it constantly. In ULTI, we put it's an actively managed fund too, I should say. So we're not just trading on the close or at the end of the week. It's not like we reboot our portfolio on Friday and then we take off for 4 days and then show back up the next Friday to do it again. We're sitting there managing it the entire time, and we post those intraday trades on our website as soon as we do them, because we're trying to be as transparent as possible.
Yeah, that's great.
I think FEPI is just one of those funds that has been around forever. That's always been a good compromise of paying a high enough yield where it's attractive, but not such a high yield it destroys the NAV. And like you say, FEPI's NAV is down maybe 10% in 2 years. So basically, that's basically flat. I mean, or it's close to flat, and it's just kicking this steady dividend. So my theory on that is it's because they sell monthly options instead of weekly options. Is that true, or am I off base there?
I would have to look into that. I'm sure there's times where weekly is better, and I'm sure there's times where monthly is better. I would say the big advantage that FEPI has is that it's kind of a revolutionary product where you're taking an index, but instead of selling options on the index, which aren't as volatile, we're selling them on the individual stock, and that's where we get the juice from. And that allows us to either sell maybe a call that's a little bit further out of the money because we're getting that extra volatility, or if it's closer to the money, we're collecting more premium there. So I think that's where the outperformance comes from, is doing it on the individual stocks instead of the index.
Okay, yeah, and of course the individual stock, an index might trade at a 15 vol, but an individual stock might trade at a 25 or whatever. That's speaking of that, isn't that called dispersion? You've worked at a hedge fund, you probably did dispersion trades. Are they going to bring that to ETFs?
We're looking at some of, one of the reasons why I wanted to join Rex is to bring hedge fund strategies to the ETF world. I think that's lacking, and, hedge fund strategy shouldn't just be for the ultra rich, they should be available to everybody. So we have many things in the pipeline. We're testing a lot of different strategies, that I used to use or other people here used to use. And we're going to try to come up with some more dynamic products.
I think the coolest thing that I've seen lately is the idea of having stock at the same time as selling a put spread or selling a 4-leg overlay like you guys are doing, whatever. Mm-hmm. But it's almost like cheating, isn't it? I mean, forget about, I'm not talking about you, but just say if an investor, if I bought a stock or a synthetic, I owned a deep in the money call or something, and then sold a put spread, I'm double long between the put strikes, right? So I have leverage. I have double the effect of the market, but only between those two strikes.
Right. And cool. Yeah. And we like having that, except on days like today.
Well, yeah. But it's almost like and I think of it almost like leverage. There's funds in England right now, I think Income Shares, or maybe they're Canada, and they own stock and just sell a naked put at the same, and that the naked put is how they make income. Mm-hmm. But of course, so they're double long. Well, I don't have to tell you, they're double long in a big part of the spectrum. Anything below the money, they have double the exposure. But anyway, they'd be really hurting on a day like today. Just be glad you guys use spreads.
Yeah, it was definitely helpful to have those puts to take us out of a couple positions today.
So did you have any of the double tranches on? I haven't looked at today's.
Yes, we did, and a couple of them got hit. So yeah.
Well, I mean, that's looking forward.
some of the stocks that performed well in the beginning of the week, there were two positions that we had completely sold out of.
Okay.
But still left the options on so that if there was a massive sell-off, we would actually get, decently short. Unfortunately, those two didn't quite come off that far, but that's how this product should work. That if, we have a target on every stock each week, and if we hit it, we get out of it, and we don't look back.
What about concentration? Do you have all crypto, or do you try to only do? I mean, do you look at that, or
we don't have any direct crypto products in there. Everything is an equity. But what we do is we try to stay diversified. Although on days like today, it feels like everything's correlated. But we don't want to have more than a quarter of the portfolio in any one sector. We want the diversity because this strategy in theory should work. If the stocks stay the same, it should work. If they go up, it should work. We get hurt when it goes down, but if we have those 20 different moving pieces, and if they're all not moving together, then we feel pretty confident that it'll be a positive week for us.
Yeah, no, absolutely. Does anyone have a question in the comments? Be sure to ask it. I'd be happy to. Let's see if there's anyone else. Okay, there isn't. Here's Randy saying AIPI, SEPI, FEPI have been. No one ever talks about AIPI and SEPI, but they do a great job also, or they appear to. I have them on a report, and they seem to be up almost every day. I mean,
and it's the same type of strategy as FEPI.
Yeah, and so we have some fans of ULTI in here. That's it just came out. I mean, how do it just came out? It just came out at bad timing. How much control do you have over? I mean, once the SEC approves it, you have a little bit of you can adjust what day it comes out on. So you guys probably
can.
Okay.
Yeah, we can, and yes, and we certainly did a bad job with that. I won't get into all the reasons that we launched when we did, but we thought, from a marketing standpoint, that should have been a good time. And then, the first 3 weeks were straight down, all 20 stocks, and we're looking basically in a, we select our stocks based on implied volatility. So, we're looking for, we have many different volatility metrics that we look at to pull those stocks, but it's basically a universe of 100. And then each week we try to whittle that down to 20. But anything in the universe that we were looking at was selling off those first 3 weeks. And, but since then, everything's stabilized and it's, we're chugging along nicely. We're happy with the performance, outside of today, but days like today are going to happen, unfortunately.
Do you manage the distributions? Do you hold a little bit back, or do you have a target? How do you kind of deal with distributions?
The distributions have been consistent the last few weeks. They weren't, since we had the first 3 weeks, we haven't been able to, distribute as much as we'd like. But over the last, 4 weeks, since it's stabilized, we've kept that distribution stable, and we're also trying to make sure that the NAV doesn't erode. I think ULTI had a low of 16, and today it's going to go out, I think, a little over 17. So we've been able, and we've distributed, probably over $1 over that time. So we're trying to rebuild the NAV while also kicking out a good distribution.
Yeah, no, I hear you. But I mean, I'm rebuilding the NAV, but you need the market to cooperate also. I mean, the NAV is going to go down when the market goes down. But I know what you're saying. At the same time, if you're overpaying or also paying a bunch. So, yeah, you're trying to. So you're saying you are holding a little back?
We're holding a little bit.
Okay.
I mean, it's a little bit more complex than this, but basically we're trying to take the option premium and use that for distributions, and then use the stock length to rebuild the NAV.
I got you. I see what you're saying. You're looking at the total. I got you. Just trying.
Coming from a hedge fund, I'm always looking at total return. So sure. That's what I'm trying to keep an eye on. Obviously it's an income fund, so we want to be distributing as much as we can.
Well, very good. Well, hey, Matthew, I appreciate you being here, and I'd love to get you on for a full hour sometime. I'll have
Absolutely.
Questions prepared and everything. But yeah, let's do that soon. I know you're a busy guy, and I've been hearing you on some other. I heard you on X Spaces the other day, and I think you're finally getting out there, and it looks like people are buying your fund and really liking it. So But I appreciate you being here. Thank you very much.
Oh, thank you very much for having me, and I would love to come back.
Well, all right. Well,
Yeah,
you have a
thank
good day.
All right, thank you. You
Have a
too.
great weekend.
You too. Goodbye.
All right. So Amy, what are you doing today? What's up with you? Are your dogs behaving?
My dogs are behaving. I had to go down to the bottom of my driveway, which is a quarter of a mile on a very steep hill to take a package. So I wound up getting like soaking wet from all the snow that was melting. And I that's why I was late, because I had to get warm from coming back inside. So yeah, it was like a whole adventure, but I canceled my my auto and my home insurance for like it was a whole thing. So I've been very productive today. But
Okay. So tell me now, you guys, why don't you guys come up with a question? I feel terrible just sitting here asking all the questions. The next guy on is David Nicholas. You guys know David. He's a great guy. He's already on. He's in the waiting room. Anyway, because I didn't prepare any questions. I was hoping you guys would have. But anyway, if you guys have a question, chime in for sure. Chime in. All right. So let's let David in here.
I got to take off. I got to go.
All right.
Yeah.
Hey, Health and Wealth, thank you so much for being here. If you want to, you could stop back by, whatever. We're going to be here for another hour, it looks like. But anyway, I'm just getting tired of hearing myself talk. But Amy's going to help me with some questions on this time. We're going to talk.
Bye, guys. Bye, everybody
Oh,
watching as well. Have a great night.
Have a good one. I appreciate you. All right.
Right.
All right. Let's get David in here and see what's going on. Here he is, Mr. David Nicholas from X Funds.
Hey.
We have Miss Amy Roundhill in the house, and me, and you just missed old Health and Wealth. But anyway, how are you doing today? How are things going down there in Georgia?
Hey, doing good. Glad to be on. Glad it worked out, and thanks for doing this. So I got to hear a couple of the great speakers so far. So this is a good little party, Max.
Yeah. You've been traveling also, or something. Yeah. You almost didn't get this invite, but no, I appreciate you being here. Well, no, we have all kinds of good stuff to talk about. I've been talking about the lightning spread a bunch, but anyway, let's talk about GIAX. I mean, what's the deal with that one? Well, what have you done to that one, and how much better is it going to be?
Yeah, that's right. So, we launched GIX a little bit over a year ago, last summer. And I would say at the time it was pretty unique, right? In that I think many of our viewers know about the holdings, but it was the first, I believe the first or either the second to have a global exposure with a income overlay fund. And so, I would say that we tried something a little bit different with the fund structure. I won't bore you with all the details, but we basically tried something unique where we were actually selling call spreads on 3 of the indices, right? NASDAQ, Russell, S&P, but not selling it on the underlying holdings. And the whole idea was maybe we can actually get some, because again, I'm not a huge fan of just a straight covered call. So these are covered call spreads. But the whole idea was, well, what if we get some arbitrage that the underlying holdings actually outperform the indices? So you really don't get a lag. And, and there was times that it works and there was times that it didn't. And what we noticed, though, there was still a drag, just given that it just was not able to outperform the indices. So we said, you know what, just to clean it up and to just keep it more streamlined, let's just take the same structure that we've been running in blocks, which I think you're a fan of as far as the structure goes, the lightning spread strategy. And let's move that over to GIX. Now, it does shift the fund. So it is a more aggressive fund now, right? Because put spreads are just going to add, obviously, an extra layer of I wouldn't say risk, but you just have a little bit more downside exposure. But we're still doing that call spread, put spread combo, which I think is a really, really unique structure.
No, absolutely. Absolutely. So of course, in blocks, you have ETHA, HODL, and something else. And on 2 of them, you have call spreads. So what are those big stocks in GIAX that are the equivalent? What would they be?
Yeah, so those are going to be all the indices. So we're going to have the SPY, right, which is kind of the big obviously index fund. We're also going to have Freedom. So our 2 international positions are VEA, Vanguard Developed Markets, which we're actually writing call spreads for VEA.
And you're writing call spreads on those?
We are actually writing it directly on those. We've got the Vanguard small caps. So we got small caps. We got mid caps. We've got VUG, which is the growth index. So that's gonna cover about 40 to 50% of the fund is just going to be these index funds that we are selling call spread. So that kind of gives us our global long growth, diversified small cap, mid cap, international exposure on the call side.
And then you have single stocks.
Yeah.
And that's where the lightning spreads come in, the put spreads.
Yeah. So same like blocks, right? 50-50 or approximately 50% of the fund, individual holdings. These are high conviction names that we have. Again, these are higher vol names because, 24% is not exactly a small yield. And so the only way we couldn't achieve 24% on just the covered call spreads on the income, on the index ETFs. So, by design, we are going out and getting a little bit higher vol stocks so that we're going to be able to hopefully keep up with that 24% distribution. The way we do that is just some of these names that we can get a lot more premium for.
Yeah. Well, no, I'm just a big believer in the selling put spreads instead of call spreads. Even though a call spread, you kind of partially uncap your income. I just don't see why people don't do put spreads, I guess, other than the fact they do a little bit worse on the downside, whereas a call spread does a little better. But still, I mean, anyway, I'm a big proponent in the lightning spread. I think 2026 is going to be the year of the lightning spread. But you guys were kind of the first ones to do it. I mean, you were. Blocks was the first, I think, lightning spread fund to come out. But
yeah, it was. There was a few that were filed right after that, but you're exactly right. And just to add what you're saying, Max, I mean, we saw when crypto was doing well, June, July, August, September. And if you just look at the performance of blocks relative to Bitcoin, I'm just looking at its peak, right? Blocks was up 58%. Bitcoin was up 15%. So again, you're getting 4x the return, and a lot of that, the positions underlying were doing really well, but we were harvesting that put spread income every single couple of weeks as these positions were going up without getting capped out. And then on the call side, we were actually selling calls on the positions that were actually the laggards in the portfolio. And if you would have told me that Bitcoin would be the reason it lagged those first few months, I would have said there's no way. But it's just so it worked out in that. Again, this has to be a bias on the manager of which asset class do we think will underperform, and if we have a view on that, then we want to be selling call spreads on it.
Absolutely, no, absolutely. Let me ask you this: tell us about GLDN, and didn't you file for 3 that are coming out? I mean, I know you can't talk much, but what can you tell us on those?
Yes, we actually filed for 6. I don't even think we haven't even announced the other 2, but they are filed. So yeah, just keeping a high level, right? We've got these thematic funds. They are going to be the 4 thematic funds: gold, silver, nuclear, and defense, all going to be structured similar to blocks. And so you just kind of think high level. These are areas, and there's gold funds out there already, and there's silver funds that there's some really good ones out there. But just like blocks, if I'm an investor and I want exposure to a certain sector, I want to own the whole sector. So if I'm an investor, and this is what the funds will follow, I want to own not only the commodity GLD, but I want to own the miners. So similar structure, right? Sell call spreads potentially on GLD. Again, this is generally speaking, this is what we'll do in the fund. But if I'm going to take a similar approach, sell call spreads on GLD, sell put spreads on the gold miners. And if you look at the performance of gold miners relative to the price of gold, similar story like blocks, right? We get out the miners are almost a leveraged position on the underlying. So again, you have to be bullish on this sector. Like silver, I'm very excited about silver. So you got silver miners, you get silver, and you really get income along the way. Yeah.
So I can't. Yeah, go ahead, Amy. Sorry.
Because there are for Bitcoin, there's Bitcoin treasury companies. Are you going to include any, not miners, but actual companies that hold a reserve of gold and silver? Because that's how you have blocks constituted blocks.
Yeah. So the way the prospectus reads, you'll see that it's companies that obviously are involved in mining, but also that hold gold on the balance sheet, that have a substantial, I forget exactly how we quantify it, but that get revenue from gold-related activities. So there's that part of it. So it could be that they supply equipment to gold miners. It could be that they are land. It could be that they hold gold or silver on their balance sheet. So all that would apply and be eligible to be included into the fund. Yeah, and then right, you got the nuclear side as well, which if you've been following just on the metal side or on the commodity side there, I think uranium is going to have a blockbuster year next year. We'll see.
Yeah.
But if you just look at the historical price of uranium, when that thing starts to go, it really starts to go. And so again, we will make, do I want to sell call spreads on a commodity like uranium that has significant upside? I don't know. So you could see put spreads even on the commodity side for all the funds.
No, that's going to be so exciting. So then your defense one is called weapon, right? And it's going to be the same concept as these others. I'm calling that the blocks strategy. I mean, on my show, when we talk about GX, I say they're doing the block strategy. I mean, and I don't know if that's even right, but kind of in a broad sense of thinking, I think of it like the block strategy, because there's no other fund that does call spreads on about 35 to 40% of the portfolio that's directly invested in the commodity of whatever that is. They're pretty much that, and then sells put spreads on, individual companies in that business. I just think it's a great strategy.
No, thanks, Max. And I really am excited about that structure going forward. And again, we can do this with a lot of other areas too, right? We can do it with space. We can do it with robotics. We can do it. There's a lot of sectors that are really promising and compelling that we can do it with. But I wanted to start with these just because, again, this is where I feel in 2026, 2027, where there's going to be a lot of growth. I think the run for gold's not over, run for silver's not over. I think the run nuclear's had and uranium have it, but I still think there's a lot of room to run there. And then I also just think defense, again, this one is a little bit more macro view on the world, but if you say, hey, I want to get exposure to non-US markets, well, what do I want to buy? Do I want to buy Europe? Well, I don't really get excited about Europe as much. There's Asia, but I think the pieces I get excited for out of Europe are defense contractors. And I actually think a good majority of the growth out of Europe is going to come from defense contractors. So you just see the push with NATO spending increasing. I think it bodes well. So we'll have a mix of U.S. Defense contractors that we'll be looking at, international as well.
I got a question from a commenter. David said, on blocks, has David thought about splitting the exposure evenly Bitcoin and Ethereum? Right now you have, well, don't you have some Ethereum in blocks? Because you have DeepMind Immersion and you have ETHA, right? Tell us about it. I don't know.
Yeah, so just under 10% of the portfolio right now is Ether, is Ethereum. I agree. And we've actually been buying. So on the sell-off, we actually added to Ethereum. We did not add to Bitcoin. So if that tells you kind of my view on what I think should outperform in the short term. So we could. It's funny, the crypto world is so great, but there's some very passionate individuals about Bitcoin. And when we were launching the fund, we had a lot of people upset that we were adding Ether to it. So, but putting all that aside, I hear you. Not only that, we have to file, but the reason we don't have other crypto exposure just yet is because when we were launching, and this took a lot with the SEC to get over the ground. Blocks did. We worked on this, and we went back and forth because all of this was happening, right? A lot of these crypto funds were just getting approved as Blocks was under review with the SEC. And so we were like, you know what? We don't want anything to slow down it getting approved. So, but we can go back and do a sticker update to the fund and add Solana, XRP. There's even a Bitwise 10 ETF that I think is really unique that has a diversified. So
yeah,
no promises, but I think we'll see a lot of that in the fund.
No,
make that awesome. A different fund. I just like having it mostly Bitcoin. But I would also have a very satellite position in something that's all alternate coins, because it's more volatile, so have a better distribution, but I don't know. I like Bitcoin.
Like a separate fund.
Yes.
Yeah.
We have somebody from the audience said, tell David I said go Dogs, another Georgia fan right there.
Go Dogs. If you can see my Georgia, there we go. Go Dogs. Let's go. Go Dogs.
Did how many games did you? The last time I spoke with you it was right at the first of the football season. You said you were taking the family to a game that weekend or whatever.
Yeah. So if it was up to my father-in-law, he would have us at every single game because they are up there every single game. My kids are 8, 7, and 5, and they're good for about 45 minutes in the sun, and then they're already complaining. So we get up there usually twice a year, but we'll go up and tailgate, but usually not go to the game.
Yeah. No, I hear you. But no, I bet that's a good time. Georgia's having a good season. Mayor said, what was the problem with GX? Why did it need to be fixed or whatever? You touched on that a little bit, but maybe comment on that a little bit more.
Yeah. So again, I'm not saying anything that our community doesn't know, right? It's a fund that's distributing 24%. That the way the fund was structured, we weren't going to be able to generate 24% yield. And so what I just really wanted to try to do is I want to try to match the distribution with the underlying performance.
How do you do that? I mean, anyway, tell us how you do that.
Yeah. Well, this really just comes down to one, there's the implied volatility of the positions, but we have to be owning stocks inside the portfolio that have higher upside. The way the prospectus was before, we really could only own index funds, and then we could replicate index funds with positions, but we weren't able to concentrate in names that we thought had larger upside. So the shift is, like, for example, today, GIX is now going to be a little bit more volatile, but I think the odds of us achieving 24% distribution while the NAV still stays steady or increases is much, much higher now.
So if you're going to pay a 24% distribution, don't you need the assets in the fund to go up 24% also? From a 30,000 foot view. I mean, so I'm saying, isn't it a bet that you have to? I'm not saying it won't. If hopefully the assets in the fund go up 40 or 50%, and you have no problem at all paying a 30% distribution, you even have a little NAV growth. Is that the way it works, or am I oversimplifying it?
Well, sort of, because the underlying position growth should not be part of the distribution.
Okay.
Right, because that should be the NAV growth. You are correct, but the idea would be that because these are higher implied volatility positions, we can generate more income off of it, and so without capping the upside. So that's. But you're right. If the underlying is going up, the problem is with the call spreads. Even if those underlying positions were going up, we were going to be capping our upside, and so it was going to be tough to keep that distribution going.
I got you.
We could have, like, if we would have lowered the distribution to 10 or 11%. We probably could have kept the structure the same, and maybe that would have been okay, and our shareholders would have been okay with that. But if they keep 24, these changes were necessary.
No, all the people in my room that talk about it, they want the higher payoff. So I have a question here from Froggy in the audience. He said, "What made you decide to go for NAV growth first and income second in blocks? Is that what you did? I mean, it doesn't say that in the prospectus, does it? I think in the prospectus it does say that."
Yeah.
Oh my gosh. Okay. That's really baller. Okay. I didn't realize that.
Yep. No, and I appreciate whoever pointed that out. So I think we were also one of the first income funds that had capital appreciation as the primary goal. And I think with something like crypto, if you are someone that invests in crypto, you understand it's volatile, but I just think you are an investor that wants to see appreciation. And so that's my whole goal was we've got to give our shareholders, hopefully, increased NAV with distributions. If you can get both of them over time, you're really getting the best of all worlds. So all of our funds, the nuclear, defense, gold, silver, they're built the same way: capital appreciation first, and then income second.
So our covered calls, old guy investments, because we had another guy that's young on the channel. Well, he's actually not too young, but anyway, but it, I mean, the capped upside is out. Isn't that right? Capped upside's done. I mean, okay, that's what I've been saying forever. 2026.
It depends what your goals are. I've just never been I've been trading options for close to 20 years. There's one stock that I haven't been capped out on, and it's Aflac, right? And I mean, every other stock that we run covered call strategies on, we always end up getting capped out. A boring insurer we haven't, but again, the lower of all stocks, your odds are that you have less probability of getting capped out, but you're not going to generate a lot of income. And so it's just a trade-off. If you want high income, I just think call spreads are the second best, but put spreads, if you're okay with a little bit more downside, which again, if you're an investor in the market and you believe over time markets go up and to the right, why would I want to cap that? So yeah, if I can stomach the short term, but as long as I'm giving myself upside, put spreads should win out over calls, cover calls. I would say 100% over a 5-year period.
Yeah, no, I'm really excited about it. I've been telling people 2026 is the year of the lightning spread. And it doesn't just have to be the lightning spread. There's other strategies too that manage to have the upside to be uncapped. But anyway, but your fund's a big. I mean, you guys spearheaded it. You guys were the first ones to come out with it. When I heard about the lightning spread the first time, it didn't really sound that cool. I didn't really understand it, and I was just like, you're just double long between those two strikes. But anyway. But now that I've seen how it works, it's pretty cool.
Yeah,
it's pretty cool. Yeah. All right. Let me see if there's any other questions in here, but we've just about run out of time. Froggy says, if in agreeing with what you just said, if you invest in high conviction funds, I would rather have the extra downside with uncapped upside. Yeah. You've synthesized a growth in an income fund, or really, I guess it's not, it's growth, according to the prospectus, but you've made a growth fund that also spits off some income, and it's a cool invention. I mean, there's still no such thing as free money, but it's a cool thing. So how about this question? How do you know Jay, and how did he get involved with your funds?
Yep. So I've known Jay, probably close to 15 years now. So on the private wealth side, Jay had another company way back in the day that did institutional option strategies for private wealth firms. And so his team, they built a lot of our option strategies that we used to run on our in-house SMAs. So me and Jay have been through a lot of markets up, a lot of market downs together. But he is I probably biased, but I would put him in some of the top 5 options traders probably on Wall Street. Right? His ability and understanding of how the structure of these positions are great. And I know in Tidal has a lot of different funds.
Yeah.
But as far as knowledge of how to structure these, it's hard to find someone smarter than Jay.
Well, David, I really appreciate you taking time out of your day to be here. I really appreciate it. I just noticed we have a private chat. If you guys have been chatting at me, sorry about it. Anyway. All right, guys. Well, hey, David, thank you so much. And after maybe sometime in January, we'll get you on for a full hour.
Would love that. Thanks for having me, Max. And thanks so much.
All right. Have a good day, David. All right, Amy. So what are you doing? How's your yield night going?
Oh, yield night's great. I just added the ability for Deluxe users to track multiple portfolios, because I have multiple portfolios that have income ETFs. So being able to see what was my distribution from the latest distribution and what that is month, weekly, in here, out. And then, I also just launched subscriptions. So we have the standard and the deluxe, and I'm working on the my favorites across devices. So it's a high income ETF comparison tool if anybody doesn't know it, but it's doing really good. I'm adding new features and trying to make it so that we all have the tools we need in order to make the most informed decisions that we can.
Heck yeah. So it'll tell you what day the dividends are you can keep track of what gets paid on what day. And not only that, then you can tell you, I haven't checked it out in a couple of months, and I should have checked it out. I mean, I don't know. I haven't checked it out lately. I need to go check it out. I used to look at it all the time.
Yes. So
how much does it cost? I mean, what did you say? It has a premium level, probably $19 or $20 or something.
Yes. So there's the standard, that's $30 a year. And that just gets you no ads as a feature. And then we have the deluxe, and that's $200 a year if you pay annually. And then if you go onto, you should become an affiliate and give people your affiliate code, because you'll get 20% and they'll get 20% discount off of that.
But I'm already an affiliate for a competing product that, so I don't,
Yeah, you could do it. It's fine. You can be affiliate for both. It's fine. I'm going to be an affiliate for competing products probably too.
I hear you.
Yeah, or like different products. They answer different needs.
And it's not really a competing product, but I know a developer who's a really sharp guy. And anyway, I don't know if you've seen his product. It's called StockTools.app. He's a friend of mine. I really like him. I just don't want to do him dirty like that. I mean, because I want to try to help his company get going. But I just need to subscribe to your company just on my own. I just need to get a subscription.
Yes. And if anybody else wants the 20% off, I have a Bad Financial Decisions 20% coupon in my videos. So if you go watch that, it's in the description. So
and put it in the comments if you're able to or something. I don't know. But anyway, Howard's here. So let's talk with Howard and see what he's doing. It's 421. So let's see what's going. Hey, Howard.
Hey.
How are you doing?
Good. Good afternoon. Good evening.
Yep.
It's Friday.
Yeah, it's Friday. It's afternoon here in Austin. It's 4:20. It's of course it's 2:00. You still have some daylight left after you get out of here. We're just going to need you for about 20 minutes. Then we'll let you get on with your day. Yeah. Well, yeah. Thank you so much for being here. I think Amy, Miss Roundhill. She's stopped in today also. She hopefully will have a few questions for you. All right. Let me think of my question. K-Yield. I really like K-Yield. I have some myself. On my channel, we follow it every day, and we follow it with the other product that came out the same day, and we follow it against some other products that are similar, and it's beating all of them. It's doing great. I mean, I'm sure you know that, but I mean, I have it down like 5% or 6%. What do you have right now? I have it down like 5% since inception, which really isn't bad.
I think after today we're down 4. We were down 2, and then today had a negative 2% return. There's still work to do on that portfolio. Obviously, we want to get back to 25, but we're managing the volatility in this environment, which is, I think a lot of people are taking some profit before year end. A lot of fund managers do that. So. I think so far we've held on, with the volatility, okay. And, we'll continue to improve. And then, of course, making sure that we're able to harvest those premiums in the options market.
Yeah. When you said we're going to get back to 25, I had to think you're talking about the price. I never. Yeah.
Yeah. So that's actually a good point. The total return is down -4, but the price is down a bit more, right? Because we've distributed. So the goal is to get NAV back to 25. So that means that again, we have this concept that we want to have NAV stability. It's in these funds from a technical standpoint. If you are down too much, that's when you have these erosion effects. So we're holding on, we're clipping enough coupons, and we've talked about this bank that we still are trying to build out. So that's still the goal. Yeah.
So would you ever, if you had like an excessive amount of volatility, or in other words, the market goes down real big, would you ever just skip a dividend and say we need to keep it all for the NAV? I don't think you would, right?
No, because these particular names, most of the implied vols are 50 to 100 plus.
Yeah.
So just even, and in fact, when there's a sell-off, implied vol is even higher.
Sure.
So we'll probably, even in market environment, we'll generally write calls so we clip enough coupon for distribution, for sure, minimum. Yeah.
Yeah. Yeah. I was just wondering do you ever like just pay half the distribution and keep half of it in the fund to support? I mean, in other words, you talk about having a bank. That's what your bank is.
Yeah.
You always give out all the money you make. You could pay more, right?
We could pay more, but that would into principle. So that's why in a down environment, the minimum or that we want to do is actually write enough calls so that we can meet that distribution rate that we want to do. Yeah.
I got you. And have you been happy with K-Yields? I mean, with your ability to gather premium?
The hard part is not be able to get the premium. The hard part is actually being able to it's easier to run a fund when your NAV when you have above 25 NAV. That's kind of the thing. So right now, it's there's sort of a risk off moment. Basically, if you look at just from any stock in the market, the ones that have higher beta to the market have done worse. And that means like a lot of liquidity is being pulled out. People are really shifting to be a little bit safer just in the last few weeks, which is a bit, I guess you could, a lot of the fear about AI, maybe overspending, et cetera, is pulling some of the risk out of the market. So I think for us, we just want to weather this time, and then, risk will come back, and we want to be able to ride that tide up as well. Yeah.
Are you worried about Bitcoin being in the bear market and Bitcoin being down here? And I mean, what do you think is going to happen next year with Bitcoin?
Bitcoin goes through these cycles, the larger 7-year cycles, and then there's a shorter, cycle. I mean, I've mentioned this a little bit, which is that Bitcoin is much more widely adopted now than it was, say, 3 to 5 years ago, right? It's in a lot of institutional portfolio, and that has reflected in like the volatility falling, right? But with a lot of these Bitcoin companies, you see this concentration of Bitcoin, which is, I think for the ETFs, I kind of put that in a different category because you're a shareholder of ETF, it's still really owned by lots of people. But you do see, with more and more of these treasury companies concentrating Bitcoin, which actually, you have this equivalent in the banking sector is these like too big to fail, right? And we see just one cold from one company, you have this sort of, so that's actually a risk to the system. So we'll see how that goes. But I do think there are forces that support prices and there's forces that doesn't. The forces that support prices is that people are looking for alternative to fiat currency, right? And I think just given where debt trajectory is, there's a natural price support for alternative means of exchange, right?
Yeah.
I think then you have these sudden shocks, which is not really very inducive to the ecosystem. So
I hear you on that. Let's talk K Gold and K Silv. I really like that one. I thought I heard you on another show talking about K Gold, and were you saying that you use a little bit of leverage, and that you're like 120% long, but then you sell at 20 delta calls, so you have 100 deltas?
Yeah, so we look at the combo. Right. Okay. So if just a traditional cover call, you have delta 1 to the exposure, right? Either you have it in stock or through the synthetic long. And then you write as a 30 delta call. So your exposure is only 0.7. So that's why mathematically we say you give some upside to give the income, but really mathematically means that if you have a rising market, your exposure or sensitivity to the underlying is only 0.7. You're less than 1, right?
Yeah.
So to correct for that, what you want to do is the long to be a bit over 1, such that the combination of your long plus the option strategy gets you back to 1. So that's how we're thinking about risk exposure. Yeah.
So do you buy an extra synthetic? How do you physically do that? Or do you, I was just wondering, we should probably have your trader on to ask him, but I didn't know if you bought 260 delta deep in the money or 260 delta options together. There are 120 deltas, and then you can sell at 20 delta call. I've done that before, and that trade is still long 100 deltas.
Yeah. So right now the long is about 1.2. Okay. And then we cover that 0.2, so we get back to roughly 1. Yeah.
Yeah, because when you sell something, it's a -2. So you sell an out of the money option at -20. Those are pretty far out of the money. Also, a 20 delta option is. Or do you sell weekly or monthlies? I guess
we reset weekly, but part of the things that we do for gold that's a little bit different than equities is that outside of the huge run that obviously came back down, the volatility of gold generally is very well maintained. So like a standard one standard deviation move for gold is about 1.5%. It's been a little bit wider at 2. So actually in a straddle, if you're able to be a little bit outside that 2%, we actually do moments do short call and put, so you're harvesting premiums on both sides, and the volatility is pretty well maintained within that. So gold as an asset class is a little bit different than equities, just because there are instances, especially risk-off environments, what we've seen in the last 2-3 weeks, right, where equity sells off, gold actually does well. You have realized vol actually be higher than implied vol, so you can't always count on that premium, the difference between implied versus realized. You have to be actually a little bit range bound, and then so if realized kind of flips over, you can still get premium from the other side. So that's how gold is a little bit different than equities.
Whatever you've been doing, it's obviously you're doing it well. I'm looking here, and you're down a lot less than any of the funds you compete against, or that I look at you to compare you with. But I know a lot of people that have been happy with K-Silv. Well, I have K-Silv and K-Gold, and I've been happy with them myself. But let me ask you, back to K-Yield, and I have K-Yield also. What are you doing with Bloom Energy? It looks like you're what are you doing there? You're buying a deep in the money option and then selling is that like a diagonal strategy? Then you're selling options in a...
No. So typically, with exposures that we think we'll want to hold for a while, we'll express that in the stocks.
Yeah.
With BE and we have another one that, well, actually we just bought a new name called Fresh that we expressed in calls. Okay. So we'll enter the position in calls to get the long exposure. And if you're deep in the money, essentially the payoff is like you're owning the long, right?
Yeah.
Then it gives us the ability that when it's towards expiry, we can decide whether we want to keep it in a portfolio, and at that point we may turn it into a stock, or we just let it, expire, and it will automatically leave the portfolio, right? So so that's how we kind of think about it in terms of the exposure. I mean, there are cases where we don't have the underlying, and then we sell calls. HIMS, for example, is a name where we actually consistently sell actually at the money. The vol is really high. We think in a short term, the price will fall, so we'll clip all of the coupon. So there's just sort of different expressions depending on the underlying of how we want to get exposure. And for us, the reason why I keep saying the word delta, right, is actually that's how we kind of look at risk within the portfolio. It doesn't, whether owning stock or buying in the money call, those are implementations. So we have to decide basically, like, do we want to own it? And then once we own it, then we decide, okay, how do we want to get that exposure? And that's the difference between stocks or calls in the portfolio.
Let me ask you about in the Qs you have a trade on. In the triple Qs, you're long the call and long the put. So you own a straddle or a strangle. Is that still on? That's been on for a while. I mean, that's basically a long volatility. That trade's going to bleed. I mean, I thought you're an income fund. And I like what you're doing, but I mean, that's a hedge, right? Or explain it to us.
That is a hedge. So we're a little bit, so you can see actually, there's a few ways to get downside mitigation in the portfolio. All right. One is you can write a call. So that's a negative delta that you could decrease your exposure, right? You can buy puts, which uses up income.
Yeah.
So those are kind of the decision that we have to make in terms of, we do want to have some hedge, especially because these names are so volatile, right? So what are we protecting against? Are we protecting against individual names falling a lot? Actually, we're not, right? These are meant to be volatile stocks, so we don't want to buy insurance on the single names. But what we want to do is buy insurance when the general market sell-off. So the Qs is an overall basket, right?
Yeah.
So that would, and there's another reason is because Qs has obviously 100 names. It has diversification in it. So the premium for the insurance is actually lower. If we had bought, basically, this is actually like a basis trade. If you bought puts for every single name in the 100 in an index, it's different than buying the Qs
Yeah.
with that, because the internal diversification that happens, right? So we actually also want to implement the hedge in the cheapest ways possible. So going back to your original question, like, hey, you're using up some of the income. So we're trying to use the least amount of income to get the protection for the portfolio. Yeah.
No, I get it. I get it. And I show people all the time how on that trade, even if volatility just goes up out of the blue, you know, and you have multiple ways of winning, but it's also, it's hedging against volatility because you buy that strangle when volatility is low. And then, you know, the market doesn't have to crater. If the market craters, it will help the trade. But if volatility, you know, doubles overnight because of some tweet or something, that position will be profitable regardless of what happens to. It's a good hedge. I know, I love that. I talk about that trade all the time, and I talk about the Bloom Energy trade, and I always describe you guys as riverboat gamblers. I mean that as a compliment. What I mean is there's some funds out there that just sell all the premium they can. It looks like you guys take a holistic approach and you sell a lot of premium, but occasionally you buy premium. And
yeah, so let me give you an example, right?
Yeah.
AppLovin is like a company we really like. It's about the same market cap as Salesforce, but it's like 80% profit margin. Like we really like, right? We like the name, so we express it in the stock. But actually, if you look at the premium that you can get from the options, is actually fallen a lot.
Yeah.
So for instance, so in that case, we're unwilling to write a call at any given, you know, level. So what we want to do is to have the long exposure, and then it's not worth it for us to write the call on it. Yeah. So you'll see for that name, there's no call versus the other names where we think, okay, given the implied vol, it's worth it to harvest.
No, I love that because it's not, I mean, I like systems and everything too. Other funds just have a system. Hey, we're going to own this basket and we're going to sell calls, and that's fine too. But you guys do it on a case by case. Sometimes you're long and you don't have any sold options. And sometimes you do. You might have calls in, you know, you can run the gamut. I really like that.
Yeah, we do have a system, but it is based upon the behavior of the underlying security, right? So like for our precious metals, like the gold, we don't write calls because if that's meant to hedge, why are you covering if there's a mean reverting event in the market, right? So there's sort of a logic between, not all stocks are the same. So yeah.
Yeah, no, I get you. I get you. No, I think that's great. Well, I think that I think K Yield's been interesting. We didn't talk about KQQQ or about lots of other things. You have lots of good products out there. Unfortunately, we've just about run out of time, but I want to have you on in January or next time you come out with a new product, and you're coming out with new products all the time. But I want to have you on for a full half hour and get to some of these questions. I don't think we missed any questions. You got a lot of compliments here in the comments. People love Curve. You're doing a good job. People like that you're so conscious about protecting the NAV by making the dividend reasonable, still high enough to be interesting, but at the same time, you're doing what you can. So I think that people in my audience really appreciate that, and I appreciate you being on the show today, Howard.
Yeah, thank you, and Merry Christmas to everyone.
All right, you have a good one, Howard.
Okay, bye.
All right, we got David in the house. You're our last one.
We got
Brad too. We got Brad. We got David. I don't recognize the third person.
Oh, Marcos.
Oh, okay. I know Marcos. Okay, it's the lighting's bad. Come on, you guys got to get Marcos. He's the young guy. Get him up front. Come on, you guys need to sit in the back. I'm just joking. All right. Well, no, that's awesome. You guys, what's going on in Costa Rica?
We just had a really nice options roundtable with our partners, our Quantify Funds partners in the options space, Convexitas, with our co-PM on our new lineup coming out, Zed Francis. I have all the respect in the world for Howard and his team and some of the things he's doing. I'm really happy to see people bring real thought into the construction of their products. That's really what we spent the last hour and a half talking about. There's just so many things that seem to be done in the ETF wrapper, specifically the income ETF wrapper, for simplicity purposes, for sales purposes, to try to gimmick the price return on a Yahoo chart when there's momentum on the underlying. that it's really refreshing to see managers that are putting real thought into the construction of their portfolios. Actually, one of the most interesting conversations we had was a question that Brad actually kicked off as to, when should you, for example, write, if you're thinking about the S&P 500, at the money calls on half of the portfolio, or 2% out of the money calls on 100% of the portfolio. A lot of these funds tend to just willy-nilly just do one thing or the other. But Zed had a really amazing detailed explanation that it's really based on the skew profile of the underlying and how consistent that skew is. And for me, as someone who's been a 22-year expert in the ETF space, it's amazing to see you all really gravitate towards the managers that are just not doing, nosebleeds distributions or alluding to be doing covered calls and really just adding leverage and really putting thought into the construction of the portfolios. We are coming to the market in the income space at the end of the year. Our likely targeted launch date is December 29th or 30th. And our effective date is coming up in hopefully the next week and a half, so we can really start divulging some information there. But honestly, I think Howard's firm, Curve, is doing a really amazing job in that space. And, we hope to bring equally thoughtful products to the derivative income space as well.
Yeah. What did you guys think about the sell-off today? It was kind of a rough day with a lot of I was down big today. But anyway, hopefully it'll be back. I don't know.
I can answer that question.
Yes, sir.
Dave is working so hard all day learning things that I didn't have time to check my portfolio.
You don't want to, trust me. If you have some of the same stuff I do and you don't, it's a time.
I want to say, I bet gold is up.
Oh, I was just messing. No, we've had a good time. We've had like 5 managers on before you guys, 20 minutes each and no break in between. We've been going a mile a minute. I believe you told me, David, that the effective date was the 24th of December.
The effective date is currently set for the 23rd. We could still receive comments from the SEC that could push that back a day or two. But that should give us a little bit of time to really give some details on the strategy before our launch date on the 29th and 30th. So I'll be joining your show on the 26th.
I think it was the 24th. Maybe it's like whenever it is. We'll get together. I thought it was the 24th. But yeah, whenever it is, I'm going to be traveling after anyway. But yeah, let's do it on the 24th. I can't wait. I can't wait to hear about the combined products. But no, I'm glad. So are you guys so do you know all the other fund managers? Do you know the guys at Round Hill? And do you know the guys do you know Will at Granite Shares? And are you guys friends and have beers together behind the scenes or not? Or is it
it's a really small world.
Okay.
ETF marketplace is a really small world. I joined the ETF world in 2007, about like 9 months before the market started getting really, really volatile. And what I would say is everyone who was really a go-getter in the marketplace at that time is an industry leader today. We were all young bucks in the industry at that point, but I've known many of these people for over a decade. And, some people have amazing, amazing products, and it's an amazing growing community. I do think there's a few select managers that are doing a really good job in this market, not launching products that just are easy to sell. They might be actually a little bit more complex to sell, but have a lot more thought that go into them. And, financial advisors, not all of them, I don't want to categorize them as a whole, but many of them have short attention spans and they actually aren't focusing that much on the research. And, the old adage in the ETF space is you better keep it simple because they have short attention spans. But we're entering this new world. You guys are doing hours of due diligence on all of these products and managers, and that allows us to bring true hedge fund-like strategies in the ETF wrapper. There's a lot of people who are using that lingo nowadays. I think the next couple of years, we're really going to delineate who's actually doing a thoughtful, intelligent strategy in a wrapper and who is, again, just using industry phrases to sound like they're doing complex things. I love the lineup that Curve offers. I think they're doing some really interesting things.
Yeah.
And we'll be entering in the space with this stacked concept, really interesting derivative income strategies on each leg. But the idea is if you can use leverage and force diversification in that leverage by stacking 2 independent strategies forcing the rebalance between them, have two really optimal derivative income strategies on each leg. And I think the hardest thing to do as a trader is to actually trim your winners and buy your losers. And we're going to force you to do that. And so I like to call it responsible leverage, where we're forcing you to take advantage of what I think is the only free lunch in markets, which is correlation and diversification. That's one of the closest things to insurance in the market. You can't predict the direction of the market next week, but you can likely have an expectation of how correlations will hold up in different volatile environments. And I think that's a way for, at the end of the day, derivative income strategies sometimes underperform on the total return and outperform on Sharpe ratio. And what a hedge fund really does is they find the optimal Sharpe ratio and they add an appropriate amount of leverage to then outperform on a total return basis. And it's much easier to use a little bit of leverage to structurally diversify a portfolio than it is to necessarily be an individual stock picker. So our first foray in the ETF space was BTGD. It's a stacked product, 100% Bitcoin, 100% gold. We've been fortunate to have, even though we have 200% total exposure, we have less drawdown than just Bitcoin alone and more upside because we thoughtfully constructed this where the two legs of our portfolio are diversified in that even though we have this leverage, it's actually showing on the upside much more than it's showing the downside. And we're very excited to bring that to the derivative income space in the coming weeks.
So on BTGD, is that the fund that's going to be doing weekly dividends, or is that another fund? We had a question from the crowd.
Yeah, absolutely. So BTGD is not going to do weekly dividends. BTGD is going to stay as a capital appreciation vehicle, but we'll have ISBG, income stacked Bitcoin and gold. So it'll have a similar exposure profile as BTGD with 100% of the Bitcoin side, 100% of the gold side, each with its own derivative income strategy. Howard also astutely pointed out that each asset needs its own option strategy and they need to be very different and they need to evolve based on the changing market dynamics of that underlying strategy, whether it's the volatility profile or curve or the skewness of that asset. But I think there's a lot of people out there who, spend a lot of money on marketing and not a lot of money on actual portfolio construction and the teams managing these strategies. And I'm so thankful for shows like this and individuals such as yourselves who are actually highlighting the difference in the underlying strategies and not just focusing on who's spending the largest marketing budget on TV or on Twitter or on Reddit. So,
I have a follow-up question for that. BTGD, will that pay like an annual dividend then with the excess that you got from whatever you got from gold and Bitcoin?
Yeah, BTGD will pay an annual dividend based on how much capital gains we have in the fund. We're trying to be as tax efficient as possible. So while it might hurt from a marketing perspective, we're actually trying to pay as little distributions as possible in BTGD. We're set up to pay very little, but that's why we're partnering it with ISBG. And so BTGD will be for capital appreciation with minimal dividends, and ISBG will be still focusing first and foremost on maximum total return with a second objective of income. And so that will be a weekly payer that comes out just before the end of the year. And the two pair very well together. One is a capital appreciation vehicle and one is a total return income vehicle. So they'll obviously have similar movements based on the underlying performance of Bitcoin and gold. But one will have that managed distribution in ISBG, whereas BTGD is more just for pure capital appreciation.
Well, that's really exciting. Is there anyone else? Why isn't anyone else doing the stacked concept, or are there other people doing stacked?
There are other firms that are very successfully doing stacked products. Our partners, ReturnStackedETFs.com, WisdomTree has some stacked products. Simplify, it has some stacked products. JP Morgan just filed for a managed futures in the S&P 500 stacked product. Simplify similarly has a managed futures and S&P 500 stacked product. To my knowledge, we're the first to stack in the derivative income space. But what I would say is, I've been in the ETF industry from 2007. I've been creating, managing ETFs for the last 14 years of my career. And so our firm's goal is to innovate and not copy. So we're always trying to bring new innovative processes to the ETF space and not just Me Too products fit into a category. So we're very proudly to my knowledge, the very first income stacked lineup that will be launching in U.S. ETF marketplace.
Yeah, I'm jealous that you guys are. I'm jealous that Brad's there. It just the timing didn't work out for me. But those guys from Convexitas, that's what I would have been looking forward to seeing the most. For whatever reason, I'm really into the theory of options, and I saw them on a podcast with you, or maybe on a podcast with somebody else. But I love those guys. I mean, those guys. I'm going to go. In fact, I'm going to go watch that podcast again. I bet you guys are having a good time. How much longer are you guys down there for?
We're the first cohort of our conference ends on Monday, and then Amy is joining us on Thursday for round 2. So we're very excited for her arrival. Amy will have an equally interesting conversation with Convexitas. One of the return stack partners will be here in person next week. So we'll also talk about the theory of return stack, what institutions are using return stack, how they use it in their portfolio. And I think some people have issues wrapping their head around return stacking. It's just a form of leverage that forces diversification, that allows us to be suitable for long-term holds and not just daily use. So it takes the onus of you being a trader. Whereas if you have margin or you have leverage, you have to watch your portfolio 3-4 days a week, maybe make tweaks and rebalance. This is more of a buy and hold leverage vehicle that we can market as leverage for the long run, where we take some of the onus off of you, the allocator, to do the difficult rebalancing. Because let's face it, when Bitcoin's falling down to 80,000 in April or 86,000, as we saw last month, it's really hard to systematically be a purchaser in that space. Brad, you have some fans asking you to say hello here.
Yeah. so far, that's health and wealth out of Canada. So far, I've known everybody that's been up there.
I'm just trying to make sure you guys are seeing all the comments. No, David, I thought you were return stacked. I mean, I don't know. I mean, because I go to that site and I see return stacked. That's your partners. You have your own company. Okay.
Yeah, we have our partner, quantifyfunds.com.
Well, yeah, okay. I guess I should know that. I know you're Quantify also, but I thought Return Stack was your product, but you're actually partnering with them.
We're partnering with them. It's our ETF. They have a small economic stake in it, and then BTGD is also listed for sale on their website as well. The income stack products that we're launching will also be listed on their website. Corey Hofstein and the Resolve team are some of the smartest people I know, and I'm very happy to be partners with them. Corey's a friend of 17 years, and I think more and more you're seeing the intelligent firms that are trying to actually strive to add value kind of join forces, because there's just a lot of, quite frankly, firms that are putting out more gimmicky products that sound really nice and very easy to summarize, and ease of sale versus an appropriate structure of a product are two very different things. And we would rather have a product that is a little bit harder to understand, that we think actually has a chance of adding real value, versus one that's just very, very simple. Not to I won't name names or discredit any other managers, but you see people who are like, oh, we're going to do target XYZ on our distributions. And it's like, well, you're going to have the same target on Costco as you are on NVIDIA. That makes no sense at all.
Yeah.
Adding a layer of complexity, while might make it harder to comprehend, we think leads to a much better product in the long run. And you guys will be the judge, and time will tell, and performances will tell over time. But we think we're bringing some of the smartest options minds to date in the ETF wrapper, especially with our partnership with Convexitas, our partnership with Return Stack. Corey Hofstein at Return Stack, at a newfound within Return Stack, has one of the most famous quant podcasts, Flirting with Models. We have a lot of brains that are going into the construction of our ETFs.
Yeah, I like that Corey Hofstein also. He has a lot of stuff on social media, but those guys from Resolve, for some reason I'm a fan of people that long volatility, and those guys always talk about long volatility. Yep. And I always watch podcasts about long volatility. We had another manager on. There was a couple of managers before you that's bringing out a fund that's going to be long S&P and long tail risk at the same time in the same fund, I think. Is that right, Amy? What was the name of that fund? Was it?
Oh, no.
Well,
right?
Oh, no, it's just no, there's one coming out, Oh, no, that's going to be just a tail risk fund that's going to have a no bleed tail risk. But then they're coming out with a fund.
He was talking about that, and then it was like Hell Yeah, which is
Hell Yeah, it's going to be long the SPY in 100%. It sounds to me like a similar concept, whatever.
You're
And-
seeing a lot of managers enter into the return stacking space. It
Yeah.
just makes too much sense. These are leverage vehicles that have much less path dependency. And again, we want to create ETF vehicles that investors have a really good experience in. And some of these leverage ETFs, if you trade them like a hedge fund where you're rebalancing your exposure every day at like 330, 345, you can get pretty close to your leverage target. But that's not the reality of what people actually do. And so by forcing that rebalancing, removing some of the downside risk by pairing two assets that are less correlated, we hopefully are providing the marketplace with products that you guys will have an amazing experience in as a shareholder. And that's what's most important to us, instead of just like raising billions of dollars on a marketing concept that might not actually hold true to what people expect over the long run.
Yeah,
So,
I'm
yeah,
so
go ahead, Amy.
because like I'm gonna have so much fun purchasing every one of them, because you're gonna have the Bitcoin and gold one. You're gonna have is it Bitcoin in the S&P 500, and then like there's just gonna be there's like how many of them? 5 that you're doing that are 3.
We'll be launching at first 2 income products at the end of December, but we filed for 8. So we'll have all sorts of pairs in broad asset classes. We'll have stocks and Bitcoin, stocks and gold, Bitcoin and gold, treasuries and gold, treasuries and Bitcoin, and stocks and treasuries. There's a lot of asset classes that are near their all-time highs, and sometimes owning them with derivative income makes a lot of sense. Again, we were actually just talking about this outside. Derivative income oftentimes has improved Sharpe ratios, but worse total return. So structurally adding leverage to a higher Sharpe ratio product is the best way to take advantage of that higher Sharpe ratio. Now, that's assuming your derivative income strategy is really targeting a high Sharpe ratio and not really just targeting max distribution. But that's why we're so excited to stack these income products that, first and foremost, total return over income. Second mandate is income. And as Amy likes to allude, we will no longer just have lazy portfolios. We will have income generating portfolios. And we're very excited to enter into that space.
So let me give everybody some risk adjusted fun, because I saw Jonathan, Ambassador Kwan, talk about my Long Island iced tea. All the events that David has tried to make me do the last 24 hours that I've been down here all have extreme risk.
I don't know if that's true, but
even going out into the waves, the lifeguard had to come out and tell us, like, hey, you guys, like, no. So there's extreme risk in everything that David has made us do since we've been down here.
I would like to say it's managed risk.
Managed risk. You have to buy that put or buy that call, because it is managed risk down here with David.
But it sounds like you guys are having a good time. Like I say, I'm jealous of all the technical talk that I'm missing out on. But I bet you guys are having a good time at the beach and doing fun stuff too.
It was interesting today with the conference about the options trades, and how he did a very good explanation of just doing one strategy in all market conditions just doesn't work.
Yeah.
Not in the long run. And being able to adjust the option strategy for the market conditions is paramount. And if funds aren't doing that, they're not going to really give you the total returns that you're looking for.
Yeah, gone are the days where you can just say, oh, this is the new way to do options in an ETF, and it's better than everything else. That frustrates me to no end. At the end of the day, if you can do an option strategy in an ETF, hedge funds have been doing it for a decade. There's no one process that just beats all. These are tools. You need to ask, who is the chef deciding which tools to use in which market? And as you see us come out with more content with our partners from both ReturnStack and Convexitas, I think you'll see we're bringing real talent to the space and really thoughtful how we construct the portfolio. As Brad alluded to, how the portfolio evolves in different marketplaces. Zero DTE has its place. Longer dated options have their place. There's no one panacea. They have to be tools that you use based on the evolving markets that are at display today.
Well, no, that's awesome. I think my theory on that was, back in the day, it's a miracle that ETFs can even trade options and have derivatives. That involved a new rule that happened like in 2019 or something that made it a lot easier. But I think the stuff that came out at first was just the easy stuff because it's easy. You put it in prospectus. You do the same thing every day. You even put it in the prospectus. We're going to do the same thing every day, regardless of other conditions. I mean, you disclaim it and just do it. And you put the onus on the customer to, not to be in it all the time. But since then, I think more creative firms have come out and they're putting more stuff into the prospectus. We're going to do this strategy under this condition. And depending on the skewness of the option, we might go further out of the money or whatever. Anyway, I just figured that at first people just rushed to get out the simple ones. But yeah, now that we have all the simple ones out, there's people coming out with, there's funds that sell call spreads on some assets and put spreads on other assets. And, that wouldn't have happened even 2 or 3 years ago. Every fund out there was just, a plain Jane covered call fund, basically.
That's what I love about the ETF space. And I think the institutional world is finally seeing it. It evolves at such a rapid pace, and what is capable of being put in an ETF continues to evolve.
Yeah.
Half the things that are being done over the last 9 months, if you ask a market maker to facilitate trades in 2 years ago, they would have thought you were absolutely crazy and hung up the phone on you.
Yeah.
Their abilities have improved. That allows us to do more complex structures in an ETF wrapper. And this is just the beginning. I'm so excited to see where the ETF world goes in a couple of years. My first ETF conference was in January 2008. It was about a 300-person conference. There was about 350 ETFs listed in the US at that time. And people were sitting around going, man, all the good ideas are done. Like maybe we should just stop launching ETFs. I said 350 ETFs. We're at about 3,600 ETFs in the US marketplace right now. Not all of them are quality, obviously, but there's some really interesting strategies that are coming out in the ETF wrapper. And the managers that are really striving to provide value in the ETF wrapper, it just kind of keeps us all on our toes to continue to innovate and offer best of breed products. And that's why you're seeing hedge fund managers come to the ETF wrapper. If it can be done in an ETF wrapper, it will. So if you think you have a good strategy, you better put it in an ETF wrapper. It is the best way to get exposure to these alternative assets. What is a hedge fund if you can't rebalance out of it once it successfully hedges or outperforms?
Yeah.
Right. That's the whole idea, is owning these structures around your beta, around your broad equity exposure. And when it does outperform or when it does diversify, being able to rebalance it and not just put in a claim to a hedge fund saying, maybe I'll get half my cash out in a year. That does nothing. The opportunity to rebalance has already come and gone. And so I think the gauntlet has been set for many hedge funds. You might have a good strategy, but if you don't consider putting it into an ETF, someone else will. And that is the best way to offer these strategies if that asset can be traded in an ETF wrapper. And if it can't today, it might be able to in 12 months.
Yes.
No, absolutely.
So I have a couple of questions.
I'm going to go get myself a cerveza. So
With some more water.
My day is done.
Take care of yourself, Brad. So the stacking, that's more of a hedge fund strategy. Could you explain a little bit more about the benefits of that versus doing a long leverage on both of those positions?
Stacking is, so you could semi-replicate a stacking process by owning leverage products on both underlying assets, but then the onus is on you to do the really difficult rebalancing. You have to rebalance 3-4 times a week. You have to sell gold as it's rallying. You have to buy Bitcoin as it's falling. And, some individual investors are diligent enough to be able to do that. But our intention is to offer buy and hold leverage ETFs. We think it's much easier to add alpha to a portfolio with structurally diversified leverage than it is to just rotate exposures or trim exposures, or some managers will hedge their entire book for a week and then unhedge it a week later. Those are really tough ways to try to add alpha over the long run. So you can reconstruct it, but you have to be very emotionless in your trading. And we found that most investors don't actually do those difficult trades. So by embedding it into the process, we should have much better long-term risk-adjusted returns than our competitors. And you've seen that. Yep. BTGD has had much less downside than just owning each individually with leverage because of the diversification and the rebalancing that we built into this ETF. And to another point is just versus traditional leverage, you can almost think of it as addition without subtraction, right? So yes, you might be a young investor who has a high beta portfolio. You have your stocks, you have your Bitcoin. You might like gold, but you might be concerned that gold it won't outperform stocks and Bitcoin. How do you add gold to your portfolio then? You stack it on top of one of those assets. It doesn't and what I mean by addition without subtraction is, in that case, gold doesn't have to outperform stocks. It doesn't have to outperform Bitcoin. It has to outperform the cost of financing for it to be accretive to your portfolio. And that's the magic of it. People are so concerned with selling down their equities and having an increased alt exposure because they're worried that that alt is going to underperform their equities. By stacking it, you no longer compare it to that equity that you would be selling it. You compare it to its financing rate, which is the beauty there. Anything that you think can outperform its financing rate can be stacked and be accretive to your portfolio. I apologize to cut this short, but everyone is pulling my chain. We're about to go watch sunset, and I appreciate you. I'll be on your show either the 24th or 26th. We'll confirm that tomorrow. Amy, I will see you in a couple of days, and thank you guys so much.
Hey, thank you, David. You guys have a good one, and tell Brad thank you too. Have a good one.
Have a great afternoon.
Yeah.
All right, Amy. Yeah, I think that went well. I think that was fun. I mean,
yeah.
It wasn't like I imagined. Rod's was more fun because we were all just talking with each other. This just turned into an interview. I didn't really think this through very well. Maybe next year I'll have an hour with with just us, with you, me, and Rod and Coach. I mean, Coach, and then have the influencer or then have the managers on for 15 minutes, have another hour for them or something. But
yeah,
anyway,
I would have been here at 3:45, but for some reason in my head it became 4:45. I was like, I have an hour. I looked and I was like, shit, I'm 10 minutes late.
It's fine. Me and Rod were here. No, everything was good. It's just funny. You imagine, I imagine something, and then when something happens, then it works out different than you imagined. But no, I thought this was fun, and I appreciate you being here. I appreciate it was nice for Health and Wealth to be here, and Rod, and we had other people. I forgot to send an invite to ETF Delta or ETF Inspector, but I don't think they can do it anyway. But
maybe next year we could have some 5 minutes between. That way we can discuss the funds afterwards.
Exactly, or 10 minutes between, because this just wasn't a great format. So next year, that's exactly what we'll do. So we'll get rid of the manager, then we'll talk for or even 15 minutes, 10 minutes in between.
Or so we could talk about the fund beforehand to get people prepped what to do. This is the first time, so next year we'll know exactly what it's going to do. I think I'm supposed to say a disclaimer for the Costa Rica thing. They are paying for my my flight and my travel and everything. So I mean, there's a real disclaimer I'm supposed to say, but basically anything involving Costa Rica, just be aware that Quest Funds is sponsoring that. So take that for what it is.
Yeah, and I just want to mention the whole show was not financial advice, fun entertainment only, of course. But thank you so much, Amy, for being here, and thank you for everyone for being here. And I really appreciated it. I thought it went well. Yeah, and next year we'll just do a little bit of time between the guest, and it will be perfect.
And one last question for you. Are you more excited about the stacking technique, like the hedge stacking, or are you more excited about the lightning spreads for next year?
Well, I don't know. I don't really understand the stacking technique as well as I should, because it's not options. It's leverage. I mean, it sounds great. It sounds great. But no, I'm more excited about the lightning spread. But that's just because I don't understand. I've never worked at a hedge fund, and I don't understand it. No, what I'm really the most excited about is they're going to have stacked funds that also pay an income. So that's the one that I think I could get interested in, because I just like funds that sell options for income.
Yeah.
But I really don't. On the stacked, you have 100% of each. Wonder if they both go down at the same time. I mean, that's always. I mean, I guess that's always what I'm thinking of, and I guess that could happen. But I do like this. They have stacked funds that are stocks and bonds. Well, stocks and bonds usually don't go down at the same. I do think that they usually try to stack them with things that usually go opposite directions, So
Yeah, or at least non-correlated, like
or
gold
somewhat
equity
non-correlated.
necessarily correlated.
Yeah.
Gold equity is not necessarily correlated that way. Hopefully, even if they don't both go down at the same time, at least that's why I have so much gold in my portfolio. It's like, well, gold could go down at the same time, but hopefully just not as much as the rest of the portfolio.
Exactly. And what he says makes a lot of sense. But yeah, no, for me, it's definitely the lightning spreads, but that's, the lightning spreads are just such a baller move because, I mean, do you have blocks? Do you like it?
I own it.
Yeah.
Yes.
Me too. I mean, no, blocks is awesome. I mean, yeah, it goes down faster, but it goes up faster too. So, so I think it's the same difference basically. There's no free money. You can either have funds that go down super slow and go up super slow, or you can have funds that go down a little bit faster and up a little bit faster. It's, it's just your choice, I guess. That was my thought. Any questions from the audience? It looks like people are just wishing us well. Gold and Bitcoin went in opposite directions, but BTG, yeah, that's the part I don't understand. He keeps saying, but we do the professional rebalance, and and by doing that, it mitigates some of that damage. But that's why, I guess that's the part I really don't understand. But I guess just because they rebalance it so frequently, they just maximize every little edge they have in it. Okay, so Randy said at times two non-correlated assets can be correlated. Well, yeah, I guess that's the risk. No strategy works at all times, and so that goes for the stacking. But it does look like the stacking works about 80% of the time, and people are pretty happy with it. Do you have any BTGD, Amy?
I wish I had room in my portfolio for lazy ETFs, but I appreciate BTGD. If I had enough money and income, I would definitely be in it. But at this point,
I know, I got you. I'm the same way. I'm the same way. So what happened to marijuana ETFs? Did they license or do they unschedule marijuana or something? I mean, Randy's just saying in the comments that the marijuana ETFs are up 30 to 50%. And I heard something on Twitter that they were going to unschedule pot or something. And so everything's taking off. I didn't know if anyone else heard. Yeah, Trump, I figured that had something to do with him. I think he was threatening to a long time ago to take pot down from a Schedule 1 to like a Schedule 3. And even though that's not a huge deal, from what I understand, it would make it where the banks can bank with weed shops. Right now, weed shops can't participate in the Federal Reserve banking system. And so with this one little change, it's going to make it, even though it's not going to legalize it, it's going to make the weed business more profitable, easier to transact. That's what I understand. Other than that, I don't know anything about it. I was wondering if you guys had heard.
My problem with these very narrow themed ETFs is you think, oh yeah, it's going to be amazing. And you get into it and then nothing happens. You could have just been the S&P 500,
Yeah.
So, I was going to ask so I would love to have a stacked GIAX and blocks.
Yes.
Something where it's 100% GIAX and 100% blocks. I think that I would be super interested in doing that because it's not just Bitcoin, it's Bitcoin related ETFs or companies at that point and crypto related crypto. Anyways, yeah, I just I like where this space, the high income ETF space is going, and now we're having historical performance. Results where we can actually go back to history and say, in this time period, November was awful, but here's how it did. And
I'm getting decent at building tools. I didn't even know that I wasn't using Python until you told me that I was using Java, but it doesn't matter. Whatever is way ahead of where I was 6 months ago. And I can do studies in here. I have a NAV depletion super study where I can project how many times ULTY will split, based on different market conditions. It's a great time to be an investor, but it's also a good time for people like me that are too lazy to learn coding. But you have AI now, and you can do really cool stuff. You inspired me, but you're a real coder, but you're just using AI to I guess, to amplify your abilities. But
Yeah, I mean, it makes it easier or like quicker to
yeah,
bring things out. A lot of this stuff is boiler code, so as long as you're clear on the prompts, there's no problem with leveraging what you can do personally to create things.
Yeah, no, it just opened up a whole new world of stuff for me. I have all kinds of new ideas and stuff I'm coming out with. All right, guys. Well, I guess we can get out of here. We've been talking for 2.5 hours, which actually isn't too bad. It's still kind of light here. Maybe I'll take Jax for a walk. All right, Amy. Well, hey, I appreciate you being here, and I appreciate everyone for being here. We have 139 watching right now. That's pretty dang good. And I will talk to everyone. I don't know if there's going to be a daily factor tonight. I haven't decided. We'll see. Anyway, I'll talk to you guys later. Have a good day. Okay.